0.16%. If you combine these two funds in the same ratio as in the World Stock Fund, 45% U.S., 55% international, your resulting expense ratio will be only 0.11%, as compared to the 0.19% expense ratio for the lowest cost World Stock ETF. The low cost of the U.S. Total Market Index Fund may be due to the large size of its total assets, about 10 times that of the World Stock ETF. More information is available at the 3 Rules of Investing website. ETF versus mutual fund. You can buy an index fund as a mutual fund or as an ETF. It's so messy to explain the differences between how an ETF and a mutual fund are organized that we think we'll forego the full explanation and just get to the implications. As we've mentioned, both of them are simply ways to buy a basket of stocks or bonds all in one single purchase. With a mutual fund, you can only buy into it once a day. An ETF, on the other hand, trades at any time in the market, just like a stock. ETFs often have lower expense ratios, the fees you pay every year, than mutual funds. They can also have certain small tax advantages. So if there's a choice between an index ETF and an index mutual fund, it's usually better to buy the ETF. The only time it's not better to buy the ETF is if you're going to dribble your purchases out over many small purchases over a period of time. When you buy shares in a mutual fund, as long as it's in a no-load fund, the only kind you should buy, you don't have to pay for purchasing. When you buy shares of an ETF, however, you may have to pay brokerage fees. Again, just as you do whenever you buy and sell a stock. The brokerage fees are generally less per share if you buy in a big lump than if you string out your purchases and buy in many small lumps. In fact, if you buy too many small lumps, you could overwhelm the ETF's advantages because of all those fees. In that case, you'd be better off going with the mutual fund. What about individual stocks? Buying a World Stock Index Fund, or the combination of one domestic index fund and one international index fund, gives you the best diversified equity portfolio you can get, and at the lowest fee. This is one-stop shopping at its best. Each of the 2 World Stock ETFs we mentioned holds more than 5,000 different stocks and charges less than 0.25% per year. The average mutual fund, by contrast, holds far fewer stocks and charges 1.4%, more than 5 times as much. The average mutual fund actually charges 28 times as much as the lowest cost U.S. domestic total stock market index fund. And that's only the average fund. About half of them charge more than that. But here's another point. The actual cost of the average mutual fund is probably much more than 28 times the cost of the lowest cost total market index fund. The average equity mutual fund buys and sells stocks so much that its turnover, the ratio of stocks bought and sold to those held, can be nearly 100% a year or more. In other words, the basket of stocks in the fund gets totally transformed by the end of the year. The brokerage costs for all that buying and selling, which are taken out of the fund but aren't part of the quoted expense ratio, could add as much as another 0.5% to the cost. So, diversified low-cost index funds are a good choice. If you wanted to lower your costs even more, you could create your own basket of stocks by buying each one individually and holding on to them for many years. When you do this, there would be no cost to hold them after you bought them. That is, no expense ratio. Only the initial brokerage cost when you bought them, and eventually the brokerage cost to sell when you wanted to cash the stocks in much later. However, it's much harder to be well diversified if you buy your own stocks. Diversification among many investments cuts down on the risk of losing a lot of money in one or a few of them. If you take the do-it-yourself approach in building an index of stocks, you might wind up not buying enough different stocks to be truly well diversified. You might wind up buying a lot that were in the same industry, for example, or in industries whose securities prices tended to move together, like oil and gasoline. What about individual bonds? As one of the 10 possible investments you could consider, we mentioned bond index funds among the possible extras in your portfolio. These could consist of corporate bonds or government bonds, or both. We do briefly discuss bonds later in this chapter, and as we'll see in rule number 2, you don't really need them for most purposes. Occasionally, they could add a small measure of diversification, and therefore lower risk, and possibly a small expected return, especially for corporate bonds, but with a little added risk, the risk of corporate defaults. You could buy individual bonds, but you should buy enough different individual bonds to be well diversified, which may be even more difficult to do yourself than it is with stocks. The corporate bonds available for individuals to purchase are concentrated in only a few industries, making diversification challenging. If you buy a bond mutual fund or ETF instead, usually the fund rolls over the bonds. That is, buys some and perhaps sells some, in such a way as to keep their average maturity approximately constant. If it's an intermediate bond fund, for example, with an average maturity of, say, 6 years, then when some bonds mature, others will be bought to maintain the average maturity. If you could buy your own bonds instead, you could arrange them so they produce your desired cash flows. You might organize them so they mature on different dates, just as you need the funds, and keep them until they mature. That way, you only need to buy them once. This approach is called laddering the bonds. Insurance products. Income annuities and life insurance. The last two products on our short list of investment vehicles are single premium income annuities and low-cost term life insurance. We will be considering only simple annuities, which means that you pay a lump sum for them, and they provide you a stream of equal periodic payments, typically monthly, until death. The simple annuities available to you to buy could be inflation-adjusted or not. That is, the equal periodic payments could be in nominal dollars. For example, $1,000 a month, or in real, that is, inflation-adjusted dollars. We'll also talk a little about life insurance in this section. We won't talk about health insurance or any other kind of insurance protection. Why only these kinds of insurance? Simple annuities and term life insurance. Because they're useful for the planning of lifetime cash flows. In particular, they insure you against early or late death and the cash flows that each require. In addition, they are simple enough that they're not easy targets for product confusion, one of the two main sources of overcharging. Their simplicity also means that it's more difficult for sellers to create the other source of overcharging, price confusion, because they have to compete with each other to sell the same basic transparent product. You should keep an astronomical distance between yourself and annuities with names like variable annuity and equity-linked annuity. These are among the most egregious examples of products that charge incredibly high fees because people don't understand them. Insurance companies truly do provide a service when they offer easy-to-understand, simple service, even with fully transparent pricing, so they have less need, as well as less ability, to create price and product confusion. A simple annuity can be a single premium immediate annuity, SPIA, or a deferred income annuity, DIA. With an SPIA, the purchaser pays a lump sum at, let's say, age 80. Then the insurer guarantees the purchaser a fixed payment, usually paid monthly, and perhaps inflation-adjusted, starting immediately until the purchaser's death. Maybe even more useful, DIAs make payments to the annuitant, purchaser, not immediately, but at some date later than the date when the annuitant pays the premium. For example, you could pay a lump sum at age 65 and start collecting at age 80. Obviously, the premium for this sort of arrangement will be much less than if payments start immediately. Annuities can help individuals guarantee their lifetime cash flow needs toward the ends of their lives, in a way that no other investment vehicle can do. If they wish to guarantee that they'll be able to leave a bequest, term life insurance can make that guarantee. If an investor's cash flow goals are clearly specified, then it's possible to plan, using a few calculations, the best mix and timing of tips, annuities, and life insurance toward the end of the investor's life, since the only uncertainty is the date of death and not the amount or timing of the payments. The calculations are beyond the scope of this text, but the reader may explore them at the 3 Rules of Investing website. The risk factor. Insurance companies can diversify the risk of any single annuity by selling many annuities. Some of their annuitants will die early and some will die late, so the insurance company's net total payouts are fairly predictable, if actuarial life expectancies remain roughly the same. When you purchase an annuity or life insurance, the insurance company is guaranteeing that you'll receive payments decades in the future. What's to guarantee that the insurance company will be around that long and that it will have the money to pay you? This is an important question. After all, in the mid-2000s, the London-based financial products division of AIG, a huge insurance company, sold so-called credit default swaps, CDSs, that were supposed to insure against a fall in the market values of certain securities called CDOs, collateralized debt obligations. But the financial products division didn't have anywhere near enough money to pay off the buyers of this insurance. This happened not decades after people had bought CDSs, but rather within a year or two after the financial products division had promised to pay off if the CDOs fell. Even the whole of AIG didn't have enough money because the payoffs were so big. And anyway, AIG itself was not liable for the promises of its financial products division. In the end, the purchasers of the insurance got paid off in full because the U.S. government stepped in and made good on the payoffs that had been promised by AIG's insurance contracts. But what if the government didn't step in? In fact, many people believe it was a mistake for the U.S. government to pay off AIG's promises in full. The next time something like this happens, we hope it won't, but it very well might, the government is less likely to pay and ensure that the insured payments on an annuity and on a life insurance contract due decades in the future can be reliably counted on. Well, we can't. But the same goes for any promised payments, even those promised by the U.S. government. Every investment has a risk. The question is, how big is that risk? In the case of annuities and life insurance, the risk can be assessed and minimized. Annuities are offered by large, well-known insurance companies like Prudential, Metropolitan Life, Principal, and Mutual of Omaha. That doesn't guarantee they'll be able to pay. Just look at AIG, an even bigger insurance company, and its CDSs. But it helps. Also, these insurance companies are rated by the same ratings agencies that rated CDOs, Moody's, S&P, and Fitch, and also by AM Best, which rates only insurers. Granted, faith in ratings was severely undermined by their role in the financial crisis, but it helps to check the ratings of your insurers anyway. Joe Tomlinson, an actuary and financial planner, looked into the question of the safety of annuities in an article in Advisor Perspectives. He found that the payment of annuities is backed up by U.S. state life and health guarantee associations, as well as a nationwide coordinating body for guarantee associations, the National Organization of Life and Health Guarantee Associations, NOLHGA. States cap the amount of the guarantee, with $250,000 of the premium being a common cap. Tomlinson concludes, history shows that annuities have traditionally been an extremely safe investment. Insurance company insolvencies have been few, companies in trouble have often sold business to healthy insurers, and guarantee associations have provided an additional safety net. In short, it seems reasonably safe to expect that an annuity will pay in full, about as safe as any investment short of United States Treasury bills. But it's not absolutely guaranteed. The best thing to do is to divide up the annuity amounts so that each premium is less than the $250,000, or sometimes $500,000, that your state of residency caps the guarantee. What about life insurance? Suppose you're 75 years old, and you want to leave $250,000 to a grandchild whenever you die. You can't be sure you can do it because you might run out of money first if you live long. You could do it, though, with level term life insurance. With that kind of insurance, you pay the same amount every year, and the contract, you could make it for $250,000, pays off when you die. That way it just becomes another predictable cash outlay. For more information on calculating a mix of tips, annuities, and life insurance, see the 3 Rules of Investing website. Other possible investment vehicles. You don't really need anything else besides what we've discussed so far: GIPs, global stocks, annuities, and term life insurance. The latter 2 are, of course, only for individuals, not for institutional investors who are managing funds like pensions and endowments. GIPs and global stocks cover almost the whole range of risk and return. That means you can select how much risk you want to take by combining those vehicles. Also, by combining GIPs and world stocks, you diversify your portfolio further, in a way, by splitting your risk between the risk of global governments failing and the risk of global corporations failing. However, if there is little or no cost for adding them, a few other investment vehicles may occasionally increase diversification somewhat and reduce risk a little. You could also increase risk if desired, possibly adding a little more expected return, but also a greater chance of loss. What's most important is that you shop for investment vehicles that carry a very low fee and then use them judiciously. Let's explore a few examples. Possible higher returns with bonds, real estate, and riskier vehicles. To keep risk reasonably low but try to get a better rate of return, instead of government-issued GIPs, you could buy a diversified set of individual corporate bonds, holding them to maturity. Unfortunately, as we mentioned earlier, inflation-protected versions of corporate bonds are generally unavailable. However, in a true global economic disaster, they may be much less safe than government bonds. History suggests that bond mutual funds, or ETFs, may not be very useful over investment horizons of 30 years or more. But for shorter horizons, low-cost bond funds could play a role. REIT funds, real estate investment trusts, can also help to diversify because they invest in real estate including land, buildings, homes, or farms. In the portion of your portfolio that is not guaranteed by GIPs, you could mix in some low-cost bond index funds and perhaps REITs to moderate the risk and price fluctuations of the more volatile global equity fund. Intermediate-term bond funds with a shorter time to maturity will fluctuate in value less than long-term bond funds, but they also will usually offer a higher return than short-term bond funds. To diversify globally, you should complement a domestic bond fund with an international bond fund. Other ways to increase risk in hopes of getting a higher rate of return include, as we've already mentioned, buying a basket of risky stocks, one at a time, and holding them for the long term. There are also very low-cost mutual funds, or ETFs, that invest in riskier sectors of the stock market, such as emerging markets. You might opt for these if you've already controlled for the risk inherent in your other investment components. Socially responsible investment. An increasing number of people have become interested in socially responsible investment. That is, investing in companies and projects that seek to achieve social and environmental goals. Socially responsible investing is certainly no worse than other active stock-picking strategies. Strong arguments can be made why it is better than most. Yet, conventional investment wisdom has long held that by investing in a socially responsible manner, investors give up something in investment return. This view is wrong, because the strategy of picking stocks by estimating whether they will benefit society in the future is certainly no less likely than any other stock-picking method to produce a good return. Nevertheless, like any active stock-picking strategy, socially responsible investing entails higher costs than passive investing. That is, investing passively in market index funds. Therefore, any would-be socially responsible investor needs to take those costs into consideration. However, At the time of this writing, socially responsible mutual funds are available at expense ratios, annual management expenses, less than 0.30%. Socially responsible funds may also be less diversified across industries than total market index funds. Alternative investments. Only very rarely is there an unconventional investment, sometimes called an alternative investment, that makes sense and is not too expensive to invest in. Normally, they are too difficult to find, their fees are too high, and it takes too much effort to determine, if it's even possible, whether they're any good. The cost-benefit analysis of alternative investments is simply unattractive. As we've pointed out, no more than 1 in 1,000 such products can provide any benefit. Some more adventuresome readers, however, may want to play around with other investment vehicles in that part of their portfolio in which they're willing to take more risk. If you can buy individual stocks, then why not other risky investments, if the cost of buying them is not too great? An example of just such an investment appeared in a 2007 article about hedge fund manager John Tsui. A hedge fund is a basket of a variety of types of investments that is available only to private, usually very wealthy investors, or to institutional investors, like endowment funds and large pension funds, not to smaller investors. But remember that this does not by any means imply that hedge funds are generally better investments. See Deadly Temptation number 6 in Part 2. Tsui's hedge fund consisted of catastrophe bonds. Catastrophe bonds, or CAT bonds, are issued to the public to cover claims that an insurance company may receive for damages from earthquakes, hurricanes, floods, and other large-scale disasters. CAT bonds really are an uncorrelated asset class, meaning there's no reason an earthquake or tornado should hit at the same time as a market meltdown. There's no correlation between these events. This quality makes CAT bonds a good way to diversify, reduce, risk. On top of this, Tsui was not charging the usual sky-high hedge fund fees, but way lower fees, just 0.25%. If you can find an investment opportunity like this, and then are willing to dedicate the large amount of time it takes to analyze it, to make super sure it's that 1 in 1,000 sensible deal, and its fees don't obliterate whatever possible advantage you might get out of it, then go ahead and dabble in it. As long as it doesn't put you at risk of not meeting your most basic goals, an investment like this could be worth your while. It should be noted that at the time of this writing, CAT bonds are available for purchase only to institutional investors. Furthermore, if you're a very wealthy investor, or even the administrator of a large institutional fund, like a pension fund or an endowment, you could consider investing directly in, for example, technology startups that could help to solve the world's energy or water or health problems. It's better to invest directly by providing finances, capital, straight to the founders of a company, if you can, than through investment vehicles offered by the financial industry, like hedge funds or private equity funds, because you'll avoid their high fees. An investor who is sophisticated enough to know that 99.9% of the investments available are not worth thinking about at all can keep her mind open. Occasionally, there's something worth considering, but frankly, you don't really need it. GIPs and world stocks will do you fine. Summary of rule number 1. 1. You can ignore 99.9% of the investments offered by the financial industry and limit yourself to, at most, 10 specific low-cost investment vehicles. 2. The least risky of these vehicles is government inflation-protected securities, and the most risky is a low-cost World Stock Index Fund, or ETF. 3. In addition, if you're an individual investor, you may consider simple annuities, though not other kinds of annuities, and term life insurance. Rule number 2. Look only forward. Now that we've pared the number of investment vehicles you should consider by about 99.9%, we'll reduce them even further, and we'll delve into how you should use them. If you read only one section of this book, this is it. It will tell you what your winning investment strategy is. This advice applies whether you're an individual creating her lifetime saving and spending plan, or the administrator of a multi-billion-dollar pension or endowment fund. First, let's note how different this will be from the usual investing frenzy that people go through. They'll often comb through the past history of the thousands, indeed tens of thousands, of available investment alternatives, or hire a high-paid advisor or consultant to comb through it for them and make recommendations. Then they'll often choose based mostly on which ones had better returns historically, completely ignoring the perfectly accurate admonition required by the U.S. Securities and Exchange Commission. Past results are no guarantee of future performance. Then, once these typical investors have made their choices, they'll stress constantly about how well their investments are performing, wondering if they should replace them with others. We won't do any of that. In fact, we'll never look back, only forward. Our rules offer a basic foundation that is different from traditional practices. Instead of constantly looking backward at historical performance, our strategy requires investors to envision their future goals and aim toward them. The ultimate in simplicity and sophistication. Here is your basic goal. Whatever kind of investor you are, you would like to get as much return as you can from your investments, and you would like to be as certain as possible of getting it. These two objectives are at war with each other, because that which is certain is low risk, and that which is low risk is less likely to produce a high return. To put it another way, a guaranteed safety net is more expensive than a shaky net. Therefore, the guaranteed safety net gives you a lower return on your investment than the less expensive shaky net does, if it works out. You will have to compromise. You will have to decide how much of a guaranteed safety net you can afford, how much you want for certain and are willing to pay for, and how much you can only gamble for. As rule number 1 made clear in the last chapter, all you really need are 2 investments. One, GIPS, provides the strongest safety net you can possibly get, though at a cost. The other, a world equity fund, provides as much risk as you should prudently take. That is, as much of the risk that is likely to provide a commensurate reward. These are at poles on the risk scale. Now let's explore how these 2 investments can be applied to 2 related scenarios. One featuring Beth, a reasonably well-off individual investor planning a lifetime saving and spending schedule, and another starring Ralph, an investor who is not well-off, but is getting by, and is also making his lifetime financial plan. Looking forward with 2 investors. Beth is the reasonably well-off investor of Category 2 that we described in the introduction. Ralph represents the getting-by investor of Category 3, not struggling and lacking the finances to invest prudently, but not financially comfortable like Beth either. Both investors are looking forward to that time when they'll need to withdraw from or cash in their investments. Beth, a well-off investor. Suppose our reasonably well-off investor Beth has household income of a comfortable $150,000. She starts saving at age 35 and saves the same amount, let's say $15,000 each year, then retires at 65 and dies at 94. What Beth invests at age 35 grows in her investment account to become her retirement income at age 65. What she invests at age 36 grows to become her retirement income at age 66, and so on to ages 64 and 94, respectively. Thus, each dollar resides in Beth's account 30 years. That's enough time, according to most stock market experts, based on the history of world stocks that we've already presented, to create a high probability that stocks will offer a good return. But other experts, including Tsui, a professor of finance at Boston University and author of a leading textbook on investments, point out that there's still a substantial risk. In Japan, for example, stocks fell 80% from their height in 1989. Their prices were still more than 60% below their peak 24 years afterward. Furthermore, Some histories of stock markets have observed that most studies are of the survivors, the countries whose stock markets have survived to the present. The obvious 20th century examples of countries whose stock markets did not survive are Russia and China, where stocks lost all their value after the revolutions of 1917 and 1949. Those losses in Russia and China, however, were already included in the 2013 study of historical world stock returns that we cited in the introduction. Their impact on world stock returns over the period 1900 to 2012 was a lowering of only 0.34%. Still, there's no guarantee you won't lose money, possibly quite a lot in the stock market, especially if you're not globally diversified. So for a very solid safety net and peace of mind, if you can afford it, you may want to place some of your investments in GIPs. Beth needs to ponder exactly these points and decide how much to put in the safe investment, the GIPs, and how much in the risky one, the World Stock ETF. Hereon, we'll assume Beth's safe investment is specifically U.S. Treasury inflation-protected securities, TIPS. Here's a way she can decide. She can decide how high a safety net she wants and can afford for near absolute protection against the worst-case scenario. Then she can buy TIPS accordingly and put the remainder in a global stock index ETF. For example, suppose Beth decides she wants an absolute ironclad guarantee come hell or high water of at least an additional $22,000 annually from her investments in retirement over and above her Social Security payments. Either she or her advisor calculates that investing half her portfolio, 50% in TIPS, will secure that guarantee. Now, look at Table 2, Beth's annual income after age 65. The entry in the 50% row of the second column, the expected column, shows the nominal and real income from her investments, $82,688 and $44,138, respectively. That Beth can expect after age 65 from her SWS portfolio. Simplify Wall Street, remember? Consisting of 50% TIPS, 50% Global Stock Index ETF. If future real returns on world stocks equal their historical averages, and if inflation is what it is expected to be. The entry in the last, worst possible case column in the first row shows what she'll get in the worst possible case, if world stocks drop by 100%, losing all of their value. If Beth decides, on the other hand, that she can afford to use only 25% of her portfolio to ensure maximum security, the results are in the 25% row. This approach gives her better expected income than if she invested 50% in TIPS, but with a lower guaranteed safety net. The ups and the downs of Beth's scenario. The scenario we just assumed, the expected one, in which Beth gets a real return of 5.0% and a nominal return of 7.2% on her world stock investment, is the one we deem the most likely, given what we know now. But to get an idea of what else can happen, let's look at the high and low historical 30-year returns shown in the third and fourth columns of Table 2. In the introduction, we pointed out that over the years 1900 to 2011, the worst three-decade real return, that is, the inflation-adjusted type of return, or actual purchasing power, on global stocks, which occurred from 1910 to 1940, was 3.4%, and the worst nominal return, that is, growth in ordinary dollars, was 4.8%. The best 30-year real return was 9.9%, and the best nominal return was 13.2%. Table 2 shows what Beth would receive in income with the lowest and highest 30-year historical returns in both the 50% TIPS and 25% TIPS cases. In the best historical scenario, 13.2% nominal return and 9.9% real return, her nominal annual income with 50% TIPS would be $340,000, and with 25% TIPS, it would be almost $480,000. The corresponding real incomes would be $139,000 and $197,000, respectively. Why did we single out this last result for an exclamation mark? Only to point out that if you're tempted to play lottery with the stock market, no matter what the odds, in hopes of securing a life of leisure, the World Stock ETF is as good a place to do it as any. And just in case you're going to say, well, Beth's no Warren Buffett, then give her portfolio 60 years of investing, as he has with his, instead of 30, and the same numbers compound to an annual income of $13 million a year with 50% tips and $19 million with 25% tips. Notice how simple this is. With the 50% tips strategy, all Beth does each year is buy about $7,500 of U.S. tips and $7,500 of a global stock index ETF. That's it. That's all she has to do. She pays almost nothing in fees. She never touches her investments until she retires. She never looks back to see how they've done. Then she just makes annual withdrawals. Not only is this strategy simple, but it will provide Beth with the best return she can possibly get for the risks she takes, bar none. Why only the two assets? You might need reminding as to why Beth would opt for only these two investment vehicles. Remember, GIPS and the World Stock ETF represent the two poles of risk, figure 1. So if you combine them in different ratios, you can fall wherever you want on the risk scale. Taking more risk than the global stock ETF by investing in a less diversified portfolio may not be able to assure that your expected return will be better. But there's another reason to limit Beth's portfolio to these two particular assets. Referring back to Table 2, we can understand the reason by asking, why not increase the GIPS rate with just a little more risk by putting it in corporate bonds with a 1.2% higher rate? The reason is, that really reduces diversification in case of a very, very bad global scenario. If global stocks do terribly over some 30-year period, then that means that global corporations are failing. Hence, many corporate bonds may default. However, government bonds may not be affected, certainly not as much, because most sovereign governments can print money to pay their debts. And if the debts are inflation protected, as GIPS are, then it won't matter to the investor if that money printing causes inflation. In other words, the combination of GIPS and world stocks also diversifies you between government and corporate issuers of securities, a type of diversification, especially as a cushion against very bad scenarios, that few people ever mention, but that is important. Ralph, a getting-by investor. Now let's come to Ralph, the getting-by investor. Ralph only earns $50,000 a year and can afford to save no more than $5,000 a year. Nevertheless, he will want to supplement his Social Security payments after he retires. Ralph can't afford the TIPS safety net that Beth can afford. He will need to invest all of his savings in the less secure safety net, the world stock portfolio. Let's suppose he begins investing at age 30 and plans to retire at age 65. Each $5,000 he invests will be invested for 35 years. The last investment, at age 64, will be invested until he is 99, if he lives that long. 35 years should be long enough to weather the ups and downs of the world stock market. At least it was historically. So Ralph stands a pretty good chance of getting the expected return of 5%, or at least not too much less, and maybe more, over each 35 years. At 5%, his $5,000 will grow to $27,580 a year in real dollars, or $57,000 in nominal purchasing power dollars. Ralph's portfolio then is actually a one-asset portfolio, or two assets if he splits the world stock ETF between a lower-cost U.S. domestic total market ETF and another total international ETF. He is very likely to be okay, barring a disastrous scenario for the entire world economy, but he will be lacking the comfort and absolute security of Beth's TIPS safety net. A necessary postscript to our scenarios. We could stop talking here except for two things. First, there's still a little more to explain about the simple two-asset portfolio, nitpicky little details like tax implications. Furthermore, not every investor's situation will be as easy to describe as Beth's or Ralph's. Not everyone starts investing in the two-asset portfolio early. Some investors may be 50 or 60 or 70 years old and already have assets accumulated. The advice to those investors will be a little different, though the basic two-asset portfolio will be the same. And not everyone dies on the dot at 94 like Beth. There's some risk of dying earlier or later. So we'll talk about longevity insurance to ensure that you can keep withdrawing from your account as long as you live. We'll also talk a little about a few other investments you could make if you wanted to. You don't really need them because the two we've already mentioned, GIPS and a world stock fund, cover the spectrum of risk and return reasonably well. But a few others wouldn't hurt. You could use them if you really want to tinker. And then, of course, there's probably this other problem. You don't believe us yet. All of the other financial and investment noise you hear is still ringing in your ears. And it will keep on ringing. It's an incessant drumbeat that you can't get away from. You'll be tempted to believe it. That's why we'll have to spend all of Part 2 telling you why it's wrong. We've told you how to use the two-asset portfolio in two specific cases. The case of Beth, who starts investing at 35, retires at 65, and dies at exactly 94, and the case of Ralph, who starts investing at 30 and retires at 65. Now we'll have to add a small wrinkle or two to the story of Beth. Then we'll go on to discuss other investors whose stories may not be quite as neat and clear-cut as Beth's or Ralph's. The story of Beth continued. Annuities and taxes. Let's add two more considerations to the story of Beth, longevity and taxes. When we introduced Beth, we assumed she died when she was 94. Of course, that's a bad assumption for any real person. You don't know when you're going to die. If she dies sooner, then she won't need more from her investments than she planned. But if she dies later, she may not have enough. That's where those annuities come in. If she's still alive and kicking at age 94, she'll need another fund of money to purchase an annuity. That's why she should really start investing a little earlier, at age 30 instead of 35, or else put away a little more each year. What she invests between age 30 and 35 will be sufficient to grow to enough money to purchase an annuity that will give her income if she needs it after age 94 for the rest of her life, however long that is. Taxes are another serious consideration for Beth's story. In general, taxes are very low with the two-asset portfolio compared to other portfolios. In fact, it would be hard to construct any portfolio with lower taxes. Nevertheless, taxes will have to be paid. Specifically, Beth will have to pay taxes on the capital gains each time she cashes in a portion of the World Stock ETF, or the two ETFs that equal global coverage after her retirement. Capital gains are profits Beth makes when she sells a stock. Simply her sale price minus her original purchase price. This means her after-tax income will be a little less than the income we quoted earlier. The World Stock portfolio will pay dividends to the investor that also will be taxed. Those dividends can be automatically reinvested, but the tax on them must be paid each year if they're in a taxable account rather than in a tax-deferred account, for example, an IRA. The TIPS will also pay a small amount of interest each year, on which U.S. federal tax must be paid. TIPS are exempt from state and local taxes. In addition, U.S. federal income tax must be paid each year on any upward adjustment in the TIPS face value. For this reason, if there is a choice whether to hold the TIPS or the World Stock ETF in a tax-deferred or taxable account, it's usually better to put the TIPS in the tax-deferred account. The dividends and interest paid by the ETFs and TIPS will be more than sufficient to cover these taxes. The amount of the dividends and interest remaining after paying taxes will be reinvested, along with each year's additional contribution from Beth in the TIPS or the World Stock ETF. Starting or continuing later. Not everyone creates their whole life's saving and spending and investing plan as early as Beth and Ralph. In fact, most people don't. And even if they do, they may look at their plan and results later as things evolve, and possibly make changes if their goals change. When we suggested plans for Beth and Ralph, we planned them looking forward, not backward. Our only recourse to past history was that we used the long arc of investment history as a rough guide to what could be expected as a return on global equity investments. That same approach will guide us in making plans for people who start later, or who, like Beth and Ralph, made plans early but update them later as time goes on. Before we discuss this further, let's look at Beth's plan again. That will help us to discover how we should treat other people's plans. Refer back to the picture of Beth's plan in Figure 2. At each age, from 35 to 64, Beth invests $15,000 divided between her two investment vehicles, TIPS and World Stock ETFs. Each bar in Figure 2 shows the length of time over which the TIPS she bought in that year mature. All the TIPS she buys are 30-year TIPS. The TIPS she bought at age 35 mature, that is, pay back their principal, when she is 65, just in time to pay part of her first year's retirement income. The TIPS she bought at age 36 mature when she is 66, and so on. The TIPS in Figure 2 look a little bit like a ladder. Well, that's what they're called, a TIPS ladder, a special case of a bond ladder. At any time, Beth holds in her portfolio a series of TIPS maturing in different years. Now consider another well-off investor, Chuck. Unlike Beth, Chuck didn't start right out using the two-asset portfolio. Let's suppose he's 55 years old now and has some money saved. He'll also be contributing into his portfolio each year in the future. Look at Figure 3. We took Beth's diagram and drew a straight vertical line through Chuck's age. If you look at the gray bars to the right of Chuck's age, you'll see that at that age, Beth would have had a TIPS ladder consisting of one TIPS maturing in 10 years, one in 11 years, and so on, ending with one maturing in 30 years, the one she just bought. Figure 3. Chuck's plan. If he has enough saved to do it, Chuck could buy that exact same TIPS ladder. Then he would be on an almost equal footing with Beth. Whatever is left over, he could invest in the World Stock ETF, as Beth did. That way, he'll start out in a similar position on the ladder as Beth. Well, maybe not quite. If his remaining assets happen to be exactly the same as what he would have had, if he had been investing the same amounts as Beth in the World Stock ETF all along, then he would be in exactly the same position on the ladder as Beth. After that, Chuck could invest his contribution each year just as Beth does. Then everything would be the same as Beth. One more thing. Each investment that Beth made in the World Stock ETF stayed there for 30 years before she withdrew it. Some of Chuck's money outside of TIPS will now be invested for less than 30 years. For example, his first retirement withdrawal will occur in only 10 years. Investments in stocks can take wilder swings over shorter time periods than over longer periods. Chuck thus might want to take a little less risk than he would take if he invested it only in the World Stock ETF. Risk-return preferences. But why should that be? If Chuck's portfolio is exactly the same as Beth's, as if he had been investing like Beth all along, why wouldn't he continue to do the same thing as Beth? Whether Chuck has exactly the same portfolio as Beth has now or not, what he should do with it depends on his attitude toward risk and return. For example, we already made a tacit assumption about Beth's attitude toward risk and return. We assumed that she needed to have a 100% guaranteed safety net at some level, depending on whether she opts for 50% or 25% TIPS. Falling below that safety net was forbidden. But we made no assumption about her attitude toward risk and return beyond that. We just assumed that investing in the World Stock ETF would fit it. We don't really know if the World Stock ETF would exactly fit Beth's risk-return preferences, sometimes called her utility function, and for a good reason. We'll never know Beth's utility function. Behavioral economists sometimes run experiments to determine people's risk-return preferences. For example, they'll ask someone, would you rather gain $2 or avoid losing $1? they discover that people's preferences are internally inconsistent. That is, people will give one response to one question about risk and return, and another to another question, but the responses often logically contradict each other. It's impossible to find out with any certainty exactly what somebody's preferences are. So the ideal of calculating exactly what somebody's portfolio should be based on a precise determination of that person's risk-return preferences, or utility function, and performing the kind of mathematical optimization that financial economists dream of, is exactly that, a dream. Nevertheless, we can know some things with reasonable certainty, and the theoretical concepts, even if they're not very practical for most purposes, can help you do that. One of those things we can know with reasonable certainty is that the world stock ETF dominates other stock portfolios, in the sense that it has a lower probability of losses and better chance of gains because of its global diversification and lower fees. There's pretty good evidence that over a 30-year investment horizon, global stocks also dominate investments in bonds. That's why we didn't consider putting any bonds in Beth's portfolio, other than the government-guaranteed TIPS held to maturity, because we assumed that over a period of 30 years, their probabilities of gains or losses would be dominated by the world stock ETF. For shorter periods, however, such as 5 or 10 years, including low-cost bond index funds in the portfolio may help to contain shorter-term risk. When concentration may be better than diversification. The opposite of diversification of investments is concentration of investments. If, for example, you deliberately decide to hold a portfolio of only 10 individual stocks instead of a global stock ETF, you would be said to be concentrated. You'd hold a concentrated portfolio. What's wrong with a concentrated portfolio? Well, in the standard modern portfolio theory, MPT, analysis taught in most university investment classes in finance, the more concentrated your portfolio, the more risk you're taking on that won't be rewarded with a higher expected return. There's no point in taking on the risk of concentration if it won't be rewarded. But MPT defines risk very simplistically, as how much the market value of the investments fluctuates. This doesn't always capture what you mean by risk. In fact, sure, you could diversify so that the chances would be between adding 10% to your money or losing 10%, but that would be less interesting. So you may want to concentrate. And why not? We have to realize that risk is not always what MPT says it is. In fact, it usually is not. Back to Beth and Chuck, and even Ralph. We've just given our rationale for using only the 2-asset portfolio for Beth. What about Chuck? Some of you not for 30 years, but for only 10 or 20 years. Over that short a horizon, a bond index ETF will often have a lower probability of losses, based on history and also theory, than the world stock ETF. Let's assume Chuck has some bare minimum retirement income requirement, just like Beth. Once he creates a TIPS ladder, just like Beth's, assuming he has enough saved at 55 to do that, he will be guaranteed by the U.S. government to meet that requirement. But what should he do with the rest of his investments? What will fit his purely conceptual utility function? There's no sure way to answer this question. However, we do know one thing. If it's not simply the world stock ETF all by itself, as it is for Beth, then it is some combination of the 10 investment vehicles we listed in rule number 1. That makes it a lot easier than if we actually had to consider 100,000 investment vehicles. The simple 2-asset portfolio we introduced at the beginning, GIPS plus a global stock fund, can probably satisfy most people's risk and return preferences. And we'll show you in a moment how Beth and Chuck, and even Ralph, can continue to use it. However, risk-return preferences, or utility functions, can come in many shapes and forms. There's no scientific way to match them, or even to determine precisely what they are. As long as you stick to the 10 basic low-cost investment vehicles, and don't take too much risk overall, or for that matter too little, You can mix and match them in a variety of ways. Chuck and the two-asset portfolio. Chuck, looking forward into his future, may not want to buy exactly the same TIPS ladder as Beth would have had by age 55. He may have a different amount left over in his portfolio after buying the same TIPS ladder than Beth would have had. This alone might cause him to divide his portfolio differently. Or he may simply perceive a shorter time horizon ahead of him and want to reduce his risk. He may want to increase the TIPS ladder relative to Beth's if he can afford the extra safety net. But what if Chuck can't afford a safety net? What if he's more like Ralph than like Beth? Perhaps the assets he's accumulated are more like what Ralph will accumulate at age 55, and they won't be enough for him to afford a secure safety net. The answer is obvious. Then the ladder he gets on is the same one that Ralph would be on. Ralph didn't expect to be able to afford a safety net, and unless something unusually and massively good happens, Ralph still won't be able to afford it. Chuck is in a position as if he had started investing when Ralph started investing. He's just in the middle of it. So his two-asset portfolio will be the one-asset portfolio, the World Stock ETF, just like Ralph's. And yes, he may be biting his fingernails just like Ralph, but it's the best he can do. Chuck will have to take more chances even if he doesn't confine himself to the two-asset portfolio, no matter what mix of the 10 basic investment vehicles he chooses. This brings us to another observation about Ralph, but it applies to Beth and Chuck, too. If Ralph's investments do much better than expected by the time he reaches the age of, say, 55, he may decide he can afford a safety net now. Or, if the investor were Beth or perhaps Chuck instead of Ralph, a bigger safety net. In other words, he may decide to lock in some of his gains by putting some of his investments in TIPS. This would be a sensible thing to do. On the other hand, Ralph or Chuck may arrive at this age and find that his investments have fared far worse than predicted. In a case like this sad turn of events, he might need to work longer and/or live on less money than he had expected. This struggling investor strategy may be disappointing if you were nurtured on the 1980s and 1990s notion that everyone will become well off by investing. But it's a reality. Summary of rule number 2. 1. Look only forward to your own future plans and goals. Don't waste time poring over investments' historical performance, and don't waste money hiring someone to do so for you either. 2. An investor decides how much to put in GIPs and how much to put in a global stock index fund, the only two investments really needed, depending on how high a guaranteed secure safety net she can afford. 3. The mix can be altered over time by projecting forward to see if she can afford to strengthen the safety net. Rule number 3. Tune out noise. Rule number 3 will be short because the chapters in Part 2 will explain in detail why it's so important to follow this rule. For now, we'll simply identify some of the noisy opinions and recommendations you'll hear if you follow the two-asset portfolio route, and to all of it, we say, tune it out. You will hear that you can and must beat the market, yet you aren't trying to beat the market. Tune it out. You'll hear that you must diversify among many asset classes and many mutual funds or ETFs, yet you're only investing in one or two. Tune it out. You'll hear that you must rebalance regularly to maintain constant allocations to asset classes, yet you aren't rebalancing regularly. Tune it out. You will hear that you must use a mathematical optimization model to perform an asset allocation, yet you haven't run an asset allocation model. Tune it out. You'll hear that gold is a hedge against inflation, yet you aren't investing in gold. Tune it out. You will hear that scientifically designed funds perform better than total market index funds, yet you're investing only in the global market index. Tune it out. You will hear that you must reduce your risk as you age by using target date funds with a glide path, yet you aren't choosing a glide path. Tune it out. You will hear that rich people invest in complex, sophisticated investments, and you can also get those returns, yet you aren't investing in complex, sophisticated investments. Tune it out. You will hear that someone's financial advisor or broker gets excellent returns for his or her clients, yet you aren't using that financial advisor or broker. Tune it out. You will hear that academic studies using a 3 or 4 or 18-factor model show it's better to tilt your portfolio towards certain asset classes, yet you aren't tilting toward those asset classes. Tune it out. You will hear that you must monitor your fund's performance, yet you aren't even monitoring your fund's past performance. Tune it out. Part 2. Investing's 7 Deadly Temptations. A lie can be halfway around the world before the truth gets its boots on. Charles Haddon Spurgeon. Rule number 3 described the sort of noise you'll hear from Wall Street and the mainstream securities industry. Now, the 7 chapters of Part 2 will explain why almost all of that noise merely causes confusion and even sheer delusion in many cases. The financial industry's typical counter-arguments only contribute to the misperception that many people think investing is too complicated for them, and thus they need expert help. We admit that the noise is very tempting. It's a siren song. When you listen to Wall Street and the mainstream financial industry, you'll think that they're offering ways to make more money with your investments than you could make with much less help, using a simpler method. You'll have to remind yourself over and over again not to listen. In Part 2, we elaborate on many of the enticements that strive to make you believe that you need an expert to manage your money, or at least to steer you through the confusion, using sophisticated advice that relies on complicated models and arcane information. We call these the 7 Deadly Temptations. But know that more than these core 7 exist. Our bottom line recommendation is that you stick to the simplest possible investment strategy and, ignoring Wall Street's siren song, don't vary from it. Deadly temptation number 1. Beat the market. We told you that you must tune out siren calls to beat the market. Now we'll tell you why. The basic reason is this. You are extremely unlikely to find a manager, an advisor, or a strategy that will enable you to predictably beat the market. It will be even more difficult to know whether you have found one. It will certainly not be worth the cost to try. The odd behavior of stock prices. In their textbook, Principles of Corporate Finance, authors Richard A. Brearley and Stuart C. Myers report the following event in stock market history. In 1953, Maurice Kendall, a British statistician, presented a controversial paper to the Royal Statistical Society on the behavior of stock and commodity prices. Kendall had expected to find regular price cycles, but to his surprise, they did not seem to exist. Each series appeared to be a wandering one, almost as if once a week the demon of chance drew a random number and added it to the current price to determine the next week's price. In other words, each change in price seemed to be drawn at random from a bowl full of pieces of paper with percent price changes written on them. Up 1%, down 0.5%, up 2/3%, and so on. If that was how price changes were determined, what would be the use of trying to predict securities prices, or the stock market as a whole? Whatever you predicted, something random would happen that might agree with your prediction or might not, but it would be no better than any other prediction. This phenomenon of random securities price movements was not fully explained for more than 10 years after that. In 1965, the economist Paul Samuelson wrote a paper titled Proof that Properly Anticipated Prices Fluctuate Randomly. The proof is really pretty simple. Think about it this way. Everything about a public company, a company with stock listed on a stock exchange, that can be made public is required by law to be made public immediately. Then, thousands of analysts leap on the information and recommend buying or selling the stock based on that information. The stock reaches a consensus price almost instantly. This is what people mean when they say that markets are efficient. There's hardly any time at all between the release of a company's public information and setting that company's stock price. So, what will be its price tomorrow? Well, that depends on the information that's publicized between now and tomorrow. It could be anything, except for one fact we do know about it. It's information we know nothing about now. So it is unpredictable information. Unpredictable information is random information. It is as likely to drive the price of the stock up as to drive it down. Well, it's always very slightly more likely to drive it up because companies' earnings do grow over time on average. You can't tell which. And neither can professional investment managers, no matter how smart they are, no matter how sophisticated, no matter how good their advertising is at selling their management skills to you, and no matter how well their investments performed in the past. This is just a fact. It's provable using real data, as much real data as you'd like. It's been proven again and again and again, every decade at least and more, going all the way back to the 1930s. You cannot predict which stock, or which mutual fund, or which investment management firm will do better in the future by looking at its past performance. Many learned books about investment underscore this fact, beginning with Burton Malkiel's A Random Walk Down Wall Street, as well as Michael's previous book, The Big Investment Lie. The history of academic studies. The first widely known academic study of the investment performance of professional investors was reported in the July 1933 issue of the journal Econometrica. The study is known as the Coles Report, because it was performed by the Coles Commission, endowed by investor Alfred Coles. As reported in The Big Investment Lie, one of the first research projects of the Coles Commission was to study whether it was possible to predict the movement of stocks and stock markets. The preliminary version of the 1933 report, titled, Can Stock Market Forecasters Forecast?, was summarized in a famous three-word abstract. It is doubtful. The Coles report reviewed the stock recommendations and market forecasts of 16 financial services, 20 fire insurance companies, 24 financial publications, and those of William Peter Hamilton, the editor of the Wall Street Journal. In each case, the recommendations performed worse than the average common stock by an amount ranging from 1.2 to 4% per annum. For example, the report's summary states, 16 financial services, in making some 7,500 recommendations of individual common stocks for investment during the period from January 1st, 1928 to July 1st, 1932, compiled an average record that was worse than that of the average common stock by 1.43% annually. Statistical tests of the best individual records failed to demonstrate that they exhibited skill and indicated that they more probably were results of chance. In other words, the stock forecasters not only performed randomly, but their performance was actually even a little worse than random. In the 1964 book, The Random Character of Stock Market Prices, edited by MIT professor Paul Kuttner, two papers by Holbrook Working and MFM Osborne reported observing the same randomness in securities prices that Kendall had described to the Royal Statistical Society in 1953. Then, in 1966, William F. Sharpe, who would later win the Nobel Prize in Economics, performed a study of 34 mutual funds over two 10-year periods. He concluded, results actually obtained by the holder of mutual fund shares, after the costs associated with the operation of the fund have been deducted, fall somewhat short of those from the Dow Jones portfolio. This is consistent with our previous conclusion that, all other things being equal, the smaller a fund's expense ratio, the better the results obtained by its stockholders. A widely cited 1968 article by Michael C. Jensen, then a professor at the University of Rochester College of Business, concluded from a study of 115 mutual funds over the period 1945 to 1964 Not only that these mutual funds were on average not able to predict security prices well enough to outperform a buy the market and hold policy, but also that there is very little evidence that any individual fund was able to do significantly better than that which we expected from mere random chance. All of this evidence caused economics Nobel laureate Merton Miller to declare, if there's 10,000 people looking at the stocks and trying to pick winners, 1 in 10,000 is going to score, by chance alone, a great coup. And that's all that's going on. It's a game. It's a chance operation. And people think they are doing something purposeful, but they're really not. Nevertheless, occasionally a research study produced some pattern in past data that appeared to be predictable, because by that time it had become widely accepted in the academic community that the market was efficient and unpredictable when Professor G. William Schwert, also of the University of Rochester, studied these patterns in 2003. They were termed anomalies. After studying several claimed anomalies that had been observed in historical data, Schwert concluded with what we'll call the Schwert rule. After they are documented and analyzed in the academic literature, anomalies often seem to disappear, reverse, or attenuate. Schwert then continued, this raises the question of whether profit opportunities existed in the past but have since been arbitraged away, or whether the anomalies were simply statistical aberrations that attracted the attention of academics and practitioners. In other words, Schwert raises two possibilities. One is that the anomaly was a real phenomenon, an underpriced stock, for example, that if someone knew about could have been taken advantage of, but as soon as it was studied and publicized, the opportunity disappeared. The second possibility is that the investigator who found the anomaly had really only detected a random pattern in the data, the result of too much sifting and processing of the data, a practice called overfitting. Studies on stock performance have continued to be performed on a regular basis. For example, in 1997, Mark M. Carhart, then at the School of Business Administration at the University of Southern California, studied a sample of 1,892 mutual funds over the years 1962 through 1993, and concluded, the results do not support the existence of skilled or informed mutual fund portfolio managers, and in a 2010 study of 2,076 mutual funds, from 1975 to 2006, by Laurent Barras, Olivier Scaillet, and Russ Wermers, reported in the New York Times, the authors, using a method called the false discovery rate test, concluded that 99.4% of the managers had no stock-picking skill, while the 0.6% that appeared to have some skill was statistically indistinguishable from zero. In other words, it could easily have been a statistical fluke. The strong conclusion, as one commentator stated it, is that when you pay extra to beat the market, you end up in the long run paradoxically underperforming the market by at least the amount of your fees. The anecdotal history of star performers. Nevertheless, when people hear the results of these statistical studies, they still don't believe them. It's like a smoker who hears the results of the statistical studies that show that smoking causes cancer, but doesn't believe it will happen to him. He'll say something like, well, Homer down the road is 94, and he's been smoking for 80 years and is still fine. Homer's case, however, doesn't disprove the statistical result. Homer was just lucky. The problem is that people hear all the time about star investors who have spectacularly outperformed the market, and they ask, well, what about him or her? There are three possible answers. One is that, like Homer, that star investor was just lucky. Another is that, possibly like Homer, he did something that we don't understand that somehow staved off cancer, or beat the market. But we'll really never know which. And the third answer is, just wait. Because far more often than not, those star performers subsequently wind up plummeting to the ground. Let's take the history of these spectacular rises and falls. In fact, to start with a well-known example, one of us, Michael, was once exchanging emails with a very prominent financial journalist on the topic of the possibility of beating the market. The journalist was knowledgeable about investing and inclined to agree. But he said, "Yes, but what about Bill Miller?" Unfortunately, Michael's journalist friend wasn't quite up on the story of Bill Miller. He had old information. The Wikipedia entry on Bill Miller provides a very interesting history and analysis of Miller's investment performance from 1991 to 2005, when he beat the stock market, the Standard & Poor's S&P 500 index, 15 years in a row, becoming a legend. One analyst calculated that the probability of this happening at random was only 1 in 2.3 million, making it all but impossible that Miller's performance was only luck. But the Wikipedia site reports that another analyst disagreed with this probability calculation. In any case, it didn't last. The Schwert rule kicked in, as it almost always seems to. According to a May 2012 Forbes article, Miller's subsequent performance over the next 5 years was an appallingly bad return of minus 30.05%. compared to the market's S&P 500 return of plus 10.48%. This outcome left many latecomer investors far worse off than if they had never followed the hot money into Miller's fund in the first place. To add salt on the wound for recent hot money investors, Miller's fund charged a sky-high expense ratio of 1.77%. This is not an atypical result for investors who think that when they see that an investment manager has done well, then they should invest with that investment manager. And we won't even mention Bernie Madoff again. Two investment managers whose names are still legendary are Julian Robertson and George Soros. But few seem to know that while they both experienced long hot streaks, they both performed extremely poorly at the end of the 1990s. Robertson's funds, for example, underperformed the S&P 500 by 40% in 1999. Since this decline occurred right after his funds had the most money invested in them, $23 billion, this means it is possible that more investors may have lost money investing with Robertson than made money. Yet his reputation as an investing guru lives on. John Bogle, the founder of the Vanguard Group of mutual funds and a much-admired pioneer of index investing, reports in his book, Don't Count on It, the sad story of Gerald Tsui, a star investor of the 1960s. Tsui was the inscrutable manager who had turned in a remarkable record in running Fidelity Capital Fund, plus 296% in 1958 through 1965. Compared to a gain of 166% for the average conservative equity fund. Nevertheless, he subsequently racked up by the end of 1974 the worst 8-year performance record in the entire mutual fund industry, according to Bogle, a cumulative loss of 70%. Here's another example of reversal of investment performance from the big investment lie. A striking example of the point that past performance does not predict future performance is a story in the July 11, 2003 issue of The Economist. The Economist's story relates the astonishing fact that the top 10 mutual funds for the 3 years from the end of 1996 to the end of 1999 were all among the worst performing 7% of mutual funds in the next 3 years. If you had invested at the beginning of 2000 in the top 10 performers for the previous 3 years, you would have experienced a brutal comeuppance. In the next 3 years, you would have lost 70% of your investment. Many investors actually did this, a large proportion of them on the advice of professional investment counselors. At any time, there will always be some investment professional who has had an outstanding record of performance. In fact, this has to be true, even if performance really is completely random. If you toss 1,000 pennies 10 times, one of them will randomly come up heads 10 times in a row, even though the chances of that happening are only 1 in 1,000, and there are many thousands of investors. But if you see performance like that and assume it will continue, take John Bogle's title as your guide. Don't count on it. The trend is your friend. People seem to use the little motto, "The trend is your friend," to mean that whatever investment has performed well recently will keep on performing well. But that is a mistake. For example, many people invest in mutual funds. They have a choice of mutual funds to invest in, so they have to choose. These mutual funds always provide information about their historical returns, typically 1-year, 3-year, and 5-year investment returns. Almost invariably, people choose to invest in the fund with the best 1, 3, and 5-year returns. Many voices in the industry, financial advisors, representatives of the mutual funds, industry experts, and even impartial mutual fund screeners suggest this is logical and the best practice. It even feels good to do research and hunt down the best products. But it makes no sense. Now come on, you say. How can that make no sense? If you want to choose a lawyer, you'll want the one that has the best record of cases won to cases lost. If you want to choose a surgeon, you'll want to choose the one with the best record of successful operations as compared with unsuccessful ones. If you want to choose a baseball player, you'll choose the one with the best record of hits, home runs, and runs batted in. How can you not choose the mutual fund with the best investment record? The reason is simple. Because that record bears no, repeat, no relation to how well that fund will do in the future. Huh? You mean that if some star investment manager has done well in the past and has become a celebrity, that doesn't mean he'll do well in the future? That's right. No, it doesn't. Just the information that his historical record is good tells you nothing, absolutely nothing at all, about how well he'll perform in the future. That's why the U.S. Securities and Exchange Commission, SEC, the regulatory agency that governs much of the investment business, requires mutual funds to put words on its advertising that read something like, "Past performance is not necessarily indicative of future results," or "Past performance is not necessarily predictive of future results." The trouble is, these words aren't strong enough. The truth is that past investment performance has no ability at all to predict future results. It's not just not necessarily predictive, it's not predictive at all. What does that mean, exactly? Well, suppose you took 20 funds that performed below average in the past 5 years and 20 that performed above average. Which group do you think will have more funds performing above average in the next 5 years? You would assume more of the historical better performers will perform well in the next 5 years than the worst performers. But you'd be wrong. On average, it's just the same. A fund that performed well in the past will have no greater likelihood of doing well in the future than one that performed badly. Twice during his career, as part of his job, one of us, Michael, has worked with very large private databases of the performance of professionally managed investment funds. The first time, he had access to the largest database of professionally managed institutional investment funds in the world. Pension funds, endowment funds, foundation funds, union funds, profit-sharing funds, and others, which was privately owned by the brokerage firm A.G. Becker & Company. The second time, he had access to the database of investments managed or advised by one of the largest brokerage and investment consulting firms in the United States. In both cases, he performed studies exactly like the one we just mentioned. He looked to see how professionally managed investment accounts ranked in one 5-year time period and divided them into the best and worst performers, then looked to see how they ranked in the next 5-year time period. There was absolutely no consistency from one time period to the next. There was no way to tell how a fund would rank in the future by looking at how well it had done in the past. This phenomenon has been studied by a long series of academic investigators over several decades using a variety of methods. The results are always the same. Past performance is not at all predictive of future performance. In fact, the only thing that is predictive of after-fee investment performance is the level of fees itself. The higher the fees, the worse the fund will perform. Unfortunately, we've seen people get tripped up by their language again and again. After Michael's book, The Big Investment Lie, was published at the beginning of 2007, he did a number of speaking engagements. One time he shared the platform with another man who had also written a book. What was the nature of the man's message? He said, If your investments are not performing well for you, you should change them. What can be wrong with that? So Michael asked him, "Do you agree that you can't predict the performance of an investment?" Well, he did. Michael knew he did because he had said so in his talk. "So, do you mean that if your investments have not performed well for you, then you should get rid of them because they won't perform well in the future?" "No," he said. "I mean, if they're not performing well for you, why would you keep them?" Michael was exasperated. He couldn't seem to get clear that not performing well meant the same as haven't performed well, and haven't performed well meant it was history, and it wouldn't help you predict how investments would perform in the future. This is the tricky problem with trying to get people to understand that you just can't use past performance to predict future performance. The assumption that you can is embedded deep in our consciousness, and even in our language. Charting. Much ado about nothing. Nevertheless, lots of people use charts and statistics about past performance to try to predict future performance. This practice is called charting, and here's everything you need to know about it. It doesn't work. Or maybe the more accurate thing to say is it doesn't work statistically. That is, it doesn't work just because it works sometimes or for a while. You might play the slot machines in Vegas, and if you say to yourself every time you pull the lever on a slot machine, or whatever you do these days, "Mama needs a new pair of shoes," and you go on a winning streak, it doesn't mean that in the future you'll continue to win as long as you keep saying, "Mama needs a new pair of shoes." It doesn't work in principle, and it doesn't work empirically. That is, if someone studied a group of people who said to themselves, "Mama needs a new pair of shoes," every time they pulled the lever, and another group that didn't say that to themselves, one group wouldn't do any better than the other. That's true even if you happen to go on a winning streak once when you said to yourself, "Mama needs a new pair of shoes." The same thing is true of mutual funds and every other kind of investment. They'll win sometimes and they'll lose sometimes. Sometimes they'll go on a winning streak, but it doesn't prove that they can keep it up. Whatever they're doing is the equivalent of saying to themselves, "Mama needs a new pair of shoes." Okay. We understand that this is hard to believe. Investing isn't like playing the slot machines. In investing, there are things to know, real things. If you know them, you can predict. What things? What makes you think there aren't also real things to know when you play the slot machines? Slot machines are machines, so they have gears, connecting chains, or whatever. Actually, these days, they probably just have electronics. But still, they obey the laws of physics, like any physical device. How can that not be predictable, if you knew enough about how it works? For some reason, we have no problem understanding that it doesn't matter how much you know about how a slot machine works, you still can't predict its result. It's designed so you don't know, and it's designed well. The same thing is true of a coin toss. Everybody assumes it's random. You wouldn't expect a theoretical physicist with a PhD to predict the result any better than anyone else. So why do people assume that if you're smart enough or know enough or do enough analysis, you will be able to predict the change in price of a stock? Well, all right. We'll have to admit it. There is a difference. It's true that if you knew something about a company before anyone else knew it, you might be able to predict ahead of time how the company's stock will move. If you were the only one who knew that Apple was about to announce a new, paradigm-busting invention tomorrow, or that it was about to announce that iPhone sales were not going very well, you'd have a pretty good idea what would happen to the stock price tomorrow, and you'd buy or sell the stock accordingly. The trouble is, you don't know things like that before anyone else knows them. And if you ever do know them, you're probably a corporate insider, and it's illegal for you to trade on that information. The point is that there are many people who work full-time, and more than full-time, in most cases, in the financial industry who collect huge salaries and bonuses to try to get information like that about companies. If someone finds something that others don't know, it won't stay private for seconds. It will change the price of the stock so that it won't be a good deal to buy the stock anymore, or sell it if the news is bad. because the price will already have changed to reflect the information. It happens too quickly, just because there are so many people who get paid so well to watch out for it. True, if people who do this didn't get paid so well just to watch, there would be fewer of them doing it. Prices might not respond so fast to new information. But that's not the situation now. It's not even remotely close to the situation now. There are far too many people in the financial industry who get paid to watch out for this sort of thing. Why? Because so many people invest in the mutual fund that did the best over the past 1, 3, or 5 years. They're paying the stock analysts' salaries and bonuses by paying big fees to a mutual fund that might accidentally have done well in the past, but won't in the future. Now, suppose you find out something about Apple that you think other people don't know. How do you know they don't know it? How do you know that Apple's stock hasn't already been priced to take account of that information? Could you tell whether it has or hasn't by looking at the price of the stock? The answer is no. So, not only are you unlikely to know important information about a company before anyone else knows it, you're even more unlikely to know it and to know that no one else knows it. And if you don't know both of those things, you won't have any advantage in trading the stock. Forget the whole idea of predicting the price of a stock, not to mention a whole portfolio of stocks like a mutual fund. It's almost as unlikely that you can do it as that you'll see a unicorn. It's even less likely than winning the lottery, but the payoff isn't as big. And there's a cost to just trying to predict the price of a stock or the returns on a mutual fund. If the cost is very low, it doesn't matter much. You might as well try if you want. But usually the price isn't low. Just like if you play the lottery a lot, you'll pay and pay and pay. And yes, there's a chance you'll win, but the chances are much greater that you'll just pay and lose. Many people seem to believe that if you just trade stocks a lot, or currencies, or options, or some other thing, you can make a lot of money. This is the urban legend of day trading. We can't tell you how many times we've heard this kind of story. Someone we meet or know will mention offhandedly that some friend of theirs or relative or someone they know quit his job and just trades stocks or options or currencies at home. Sometimes they'll add that this person does very well. Sorry, it just isn't true. It's so far from the truth that it's a genuine 100% colossal whopper. People don't tell the truth about these things. It's funny how often you discover that a few months later, people who quit their jobs to make money trading securities at home are back at their jobs. If it was working so well, why didn't they keep on doing it? People who do this kind of trading tell you about their winners, but they don't tell you about their losers. And they don't tell you what their net gains or losses are. Often, they don't even know. Many day traders and at-home traders who believe they can make money this way are prey for hawkers who sell systems or training courses at tuition fees of thousands of dollars to trade stocks or options or currencies or commodities. The systems they sell can't be verified to work using any scientific procedure for verification. They just look complicated and technical enough to work. Many people who trade for themselves at home pay for systems like these and pay a lot of brokerage fees, but they almost never make much, if any, money themselves. Of course, they often lose. What they're doing is very much like gambling at Las Vegas. Their results are random, and the house takes a substantial share of what they bet. Of course, like people who gamble at Las Vegas, sometimes they make a killing, but usually not for long. You won't find anybody who started with $10,000 and spent 4 years trading at home who emerged with $1 million. Ups, downs, and ditching conventional wisdom. Earlier, we pointed out that there is no trend, but now we'll say there may be an exception. What would a trend mean anyway? Suppose the chance that a particular stock will go up tomorrow is 50%. Now, suppose on Tuesday the stock goes up. What are the chances it will go up on Wednesday? If Tuesday's result and Wednesday's result are independent of each other, that is, if there is no trend, then the chance it will go up on Wednesday is 50%, just like the chance on Tuesday. The fact that the stock went up on Tuesday hasn't changed anything. Whether or not the stock goes up on Wednesday has nothing to do with whether it went up on Tuesday. Most studies and measurements have found that there was no tendency to trend. When you assess the chances of what will happen tomorrow, it doesn't help you to know what happened yesterday. But if there were a tendency to trend, then the fact that the stock went up on Tuesday would change the probability that it will go up on Wednesday. It will make it a little higher, say 52%. More recent studies have in fact found some evidence of momentum in short-term price changes. That is, what goes up has a slight tendency to keep going up, and what goes down has a slight tendency to keep going down. The momentum effect has been documented over short time periods, such as from month to month. But reversion to the mean, which means essentially what goes up must come down, the opposite of the momentum effect, has been observed over longer periods, such as a few years. In fact, it must be observed over longer periods if there is a momentum effect over short periods. Reversion to the mean says that at some time momentum will not continue, but will reverse. Observations of financial crises suggest that momentum is gradual and long-lived, but reversal is sharp, sudden, and unpredictable. You won't get good long-run performance by relying on momentum. What causes that momentum effect? That has not been studied very well, partly because the fields of finance and economics got stuck in mainstreams, which only study the same model over and over again with slight changes here and there. But the idea is something like this. People, including professional investment managers, buy or sell securities not just by watching their prices, but by watching one another. If they think other people are going to buy and drive the price up, then they'll try to buy first, so they can take advantage of the rising price. There's an understandable tendency to think, if I managed to run fast enough to the broker to buy before the price went up too much, then I shouldn't I, be able to run fast enough to sell later before the price goes down too much. In other words, I'll get in before the price goes up too much, then I'll just yank my money out before the price drops. What makes you think you can yank your investment out faster than the price drops? Obviously, not everyone can succeed in doing that at once. You might succeed sometimes, but if you succeed only part of the time, you'll be better off not even trying. Then why is monitor your investment performance such deeply embedded conventional wisdom? The standard procedure is to compare the return you have experienced in your investments to the return on a market index. But for what purpose? If beating the market index is something that can't be done by skill but only by luck, what could possibly be the purpose of monitoring whether you did it or not? If you were gambling at Las Vegas or Macau and monitored the performance of your bets on, say, a slot machine, what would be the purpose? Would it be to determine whether you should switch slot machines? If you did that, you'd probably be going from slot machine to slot machine and not getting any better results. Well, that's what happens when you monitor your investment results. When you play the slot machines, the only thing that really matters is how much money you have left and whether you really want to bet any more of it. The history of your performance doesn't matter. It's similar with your investments. What matters is how much money you have now and what investment strategy will increase or safeguard it in the future. The history of your performance is irrelevant. That's why we told you, when you hear the noise saying you must monitor your fund's past performance, and yet you are not monitoring your fund's past performance, tune it out. Summary of Deadly Temptation number 1. 1. Beating the market is impossible except by chance. Future investment performance cannot be predicted, except for the impact of fees. 2. Monitoring past investment performance is pointless. Deadly Temptation number 2. Trust it all to our expertise. We told you in rule number 3 that if someone, a friend of yours perhaps, tells you that a particular broker or financial advisor has done very well for her clients, and you should consider hiring her, you should tune it out. Wouldn't it be great, though, to have someone take care of your investments? They would grow nicely, and you wouldn't have to worry about a thing. It sounds very comforting to have someone just deal with the whole realm of investing for you, especially if you're convinced it's all too complicated and you just don't want to think about it. But is it worth giving up 1/3 to 3/4 of your investment gains for this comfort? If you knew that another, lower-cost advisor, offering simpler, less technical-sounding investment advice, or even no advisor at all, would provide you half again to 3 times more in investment gains, then how comfortable would you feel? Because that is indeed how much it costs, even when the cost appears low as a percentage of your assets. Let's go through the numbers to show what we mean. Suppose that you're 35 and you save $10,000 a year until you're 65. And suppose your friend's advisor charges 1% of investment assets annually. All else being equal, your real investment gains when you're 65 will be only 2/3 what they would have been if you didn't have to pay the 1%. You will have lost a very large amount to pay your advisor. This becomes much worse in the typical case where investors pay fees not only for an advisor, but for overly costly investment products that the advisor recommends. For example, if the investor pays a total of 2% in additional fees, in excess of the very low fees for a global index fund and tips, then the investor will lose 60% of her investment gains as a result of these fees. If the total fees are 2.5%, as they commonly are, then the investor will lose more than 70%. See the 3 Rules of Investing website for more information. It's not worth it. Not only that, but you may actually get a poor education about investing. Most often, it is the advisor herself who is misinformed. She has absorbed the standard advice model that is so widely accepted, illogical and wrong though it may be, and she is just passing it on. This calls for a massive re-education campaign for investors, advisors, financial media representatives, and many others. If it's effective, it will change the industry. Many financial industry participants will be paid less or will find work elsewhere. Those who remain will be able to service more clients for lower fees each, because they will be able to tell the truth that it's all very simple and can be done inexpensively. Perhaps this is a utopian vision, but an industry as distorted as this one is shouldn't be able to survive in its current form forever. QAIB reports, investors behaving badly? For a number of years, a company named Dalbar has been publishing a report called the Quantitative Analysis of Investor Behavior, QAIB. The QAIB purports to show that investors make bad decisions and, as a result, their investments underperform the market by several percentage points. This material is a godsend to financial advisors because it implies that investors need to hire an expensive financial advisor to help them. It's also been a godsend to Dalbar. It has captured headlines for years, perpetuating the myth that individual investors invest poorly and therefore they do much worse than the market average. Financial advisors have been purchasing the Dalbar report in droves. The sample version of the 2013 report begins with an introduction titled The Disease of Investor Underperformance. In the lower right corner of every page of the sample version is an entry that says, Compliments from advisor name. In other words, your name, Ms. or Mr. Advisor, could go here if you purchase from Dalbar the right to distribute the report to your clients and prospects. For $1,000, advisors can buy the right to make unlimited copies for their financial advisory clients and prospects. That $1,000 is well worth it, because this report will show people how badly they'll do if they don't have expert help. There's just one thing. The Dalbar result is wrong. First, let's consider. If some group of investors underperforms the market, then there must be another group that outperforms the market. That's simply logical because between them, all investors are the market. So to make things add up, if some investors, say the individual investors who are the main subject of the Dalbar study, systematically underperform the market, then there must be some other group that systematically outperforms the market. The trouble is, there is no evidence of any such group. One would think that if individual investors underperform the market, then it must be professional investors who outperform the market. But they don't. Study after study after study, as we've pointed out, shows that professional investors do not, on average and in aggregate, outperform the market. So it simply can't be true that individual investors as a group systematically underperform the market. So why does the Dalbar study seem to show that they do? It's because of their methodology and the way they calculate investor performance. A simple explanation for Dalbar's misleading results. We'll first explain the problem in simple terms for those who don't care to get into the technical details. Then we'll explain more technically for those who do want to get into it. Dalbar measures investor returns in one way and measures mutual fund returns in another way. The measure of investor returns is meant to take into account the timing of their cash flows, while the measure of mutual fund returns doesn't. From 1982 to 2000, the stock market rose enormously, whereas after 2000, it flagged until recently. But over that whole time period, investors, especially baby boomers, were in an accumulation phase. Therefore, they had more money in their accounts in the 2000s, when their stock investments performed poorly, than they had in the 1980s and 1990s, when they performed very well. Hence, they lost more in actual dollars in the 2000s than they had gained in the roaring 1990s and 1980s. Dalbar interprets this experience as terrible timing. Yes, the timing was unfortunate, but it wasn't because investors called turns in the market wrong, consistently buying at market highs and selling at market lows, as interpreters of the study claim. In fact, the financial planner Michael Kitces has pointed out that even the Dalbar study shows that if an investor had simply invested a fixed amount in equity funds every year, the investor return would have been 3.17% a year for 20 years, compared to the actual investor return of 3.49% a year. In other words, the average investor beat an investor who merely invested a fixed amount every year. Kitces then asks, why isn't that the headline? Why isn't it indeed? Because then the result wouldn't appear to show how badly individual investors time their investments in mutual funds, and it wouldn't show how much they need the help of financial advisors, and how much financial advisors need the Dalbar report. The bottom line is, Dalbar's messaging deceives the investor, who pays far too much for advice that does him no good, because the report's incorrect conclusion convinced him that he needs it. Furthermore, it can be very difficult to tell from the wording in the Dalbar report what its methodology is. One financial planner wrote, I contacted Dalbar recently in an effort to confirm my understanding of the finer points of their calculations. They didn't respond. This is not atypical. Often, providers of financial research that serves as fuel for their clients' sales pitches don't want too close scrutiny of their methodology. Technical explanation of the flaw in the Dalbar report. There are actually two ways to calculate the rate of return on investment: the time-weighted return and the dollar-weighted return. Time-weighted returns are returns over a specific time period if you made no contributions or withdrawals from that investment. Dollar-weighted returns account for the amounts you added or withdrew from the investments, as well as the prices of any securities transactions during the time period. Obviously, the values of these two sorts of returns can be very different from each other. Ever since a 1968 study titled Measuring the Investment Performance of Pension Funds for the Purpose of Inter-Fund Comparison by the Bank Administration Institute, BAI, the principal method used to measure and compare the investment performance of managed funds like mutual funds has been the time-weighted rate. The time-weighted rate isn't affected by how much cash goes into or out of the fund. How much cash came into or out of the fund isn't under the control of its investment managers. So the time-weighted rate of return is supposed to be a pure measure of the performance of the fund's investment managers. If the fund's investors happened to throw a lot of cash into the fund just before the market took a dip, and consequently they lost a lot on the dip, That was presumably not the fault of the investment manager. The manager has no control over how much money comes into the fund or goes out. Only investors do. The other measure of rate of return, however, the dollar-weighted rate, does take account of when and how much cash came in and out of the fund. If a big wad of cash came in just before a market dip, the dollar-weighted return would be worse than the time-weighted rate. Let's take a simplified example. Suppose a mutual fund goes up 100% one year and drops 50% the next. Figure 4A. An investor invests $1, which doubles, increases by 100% to $2 in the first year, but then drops by half, minus 50%, in the second back to $1. Hence, the rate of return is 0%. Now let's suppose the investor invests $1 each year, figure 4B. The first dollar doubles to $2 in the first year. Then, $1 is added to it to make $3, but the $3 is cut in half by the minus 50% return in the second year to end with $1.50. In figure 4B, the mutual fund's rate of return is still 0% because it went up 100% in the first year and then down 50% in the second. But the investor's return is different. The investor invested $2, one each year, but wound up with only $1.50. The return the investor realized, the dollar-weighted rate of return, was a compounded annual average of minus 17.7%. The investor underperformed the mutual fund, whose return was 0%, by 17.7%. Did the investor time the market terribly? It may have turned out that way, but not because the investor was trying to time the market. The investor was merely routinely investing $1 a year. Why the dollar-weighted rate has been worse for investors? If the dollar-weighted rate was worse for investors in mutual funds than the time-weighted rates achieved by the fund's managers, Dalbar concludes it was because of poor investor decisions. But that's not what caused it. The stock market performed very well during the 1980s and 1990s, when baby boomers and others were beginning to save. But it performed poorly in the 2000s, when their cash inflows were really accumulating. The 2012 Dalbar report says, the average equity investor underperformed the S&P 500 by 4.32% for the past 20 years on an annualized basis. Now look at figure 5, which shows the performance of the Standard & Poor's 500 index, a broad measure of the U.S. stock market for that 20-year period. It zoomed up for almost the first half, then fluctuated, but went down overall in the second half. That's why investors' timing was poor, because the timing of their pattern of saving, which they really couldn't help, resulted in by far the most being invested during the period, the 2000s, when investment performance was worst. Summary of Deadly Temptation number 2. With conservative assumptions and all else being equal over 30 years, a 1% of assets annual fee will cost an investor a third of future real investment gains. A 2% fee will cost 60%, and a 2.5% fee will cost 70%. No global or major country market disaster has ever lost investors any of these percentages over the same time period. 2. The widely cited result that individual investors in mutual funds underperform by several percent a year because they time the market irrationally and poorly is wrong. Deadly Temptation number 3. Precisely calibrate your portfolio. We told you in rule number 3 that if you hear that asset allocation is the most important investment decision you can make, and that you must do it using a scientific optimization model, you should tune it out. Now we will tell you why you should tune it out. Financial advisors will often give you the idea that they can very precisely control the risk and return of your portfolio. Their spiel often starts with, the most important thing is asset allocation. Back in 1986, a paper titled Determinants of Portfolio Performance by Gary Brinson, Randy Hood, and Gil Biebauer was published in the Financial Analyst's Journal. It got a huge amount of attention. It was cited and recited, and cited again and again. Almost all of the references made to the article got its message completely wrong. It became conventional wisdom that 94% of investment performance is due to asset allocation. Well, that's not what the paper said. The co-authors thought it must have been their title that threw people off. Determinants of portfolio performance. But really, the confusion about what the paper actually said was largely due to the fact that misinterpreting it gave financial advisors a new lease on life. It offered them a new marketing pitch, which often sounded right to them, but was a misconceived mishmash of half-truths and falsehoods that they frequently passed on to clients for very substantial fees. What the paper said was not that 94% of investment performance was due to asset allocation. It said that 94% of the variability of performance was due to asset allocation. That's obviously not the same thing. Anyway, what's it all about? Asset allocation. In the Brinson, Hood, and Biebauer study, asset allocation meant how an investor's portfolio was divided among stocks, bonds, cash equivalents, and other investments. For example, the 91 pension funds they studied had an average allocation of 57.5% to common stock, 21.4% to bonds, 12.4% to cash equivalents, and 8.6% to other. Cash equivalents means short-term investments, like short-term U.S. Treasury bills, commercial paper, short-term loans to corporations, and the like. Other investments could be anything that doesn't fit into stocks, bonds, or cash, like crates of wine, art, gold, and so forth. Stock prices are more variable. They go up and down more than bond and cash equivalent prices. So it's no surprise that the way in which the portfolio is divided among stocks, bonds, and cash goes a long way toward determining how variable the portfolio's returns are. What the Brinson and colleagues' study showed was that asset allocation among stocks, bonds, and cash explained much more of the variation in a portfolio's returns than what the specific stocks in the stock portfolio were, or the particular bonds in the bond portfolio. In other words, you could guess right 94% of the time how variable the portfolio's returns would be just by knowing how it was divided between stocks, bonds, and cash, without knowing what stocks or what bonds. Somehow, that simple point got conflated by the investment advisory profession, financial planners, brokers, etc., into, you need us to help you determine the correct asset allocation because it's the most important determinant of your investment performance. Not only that, but the investment advisory profession also started to define asset allocation as something more complicated than what it really is. Asset allocation became how to divide your portfolio among several asset classes. These asset classes included subcategories of stocks like growth stocks, value stocks, small stocks, and so on. We'll now explain what's wrong with this. The main thing that's wrong with it is that a lot of financial advisors are charging an awful lot of advice that provides no benefit to their clients. Nobel Prize-winning technology. Let's start with the Nobel Prize-winning technology that's supposed to do the asset allocation for you. Many financial advisors use this approach. They sometimes make much of how sophisticated the technology is. But here's what it does: nothing. To explain this, we need to go back in history a few years. Harry Markowitz's breakthrough. Investment risk used to be perceived as an attribute of an individual asset. A broker or financial advisor who recommended a stock to a client was held by law to be in breach of his duty if the stock was too risky for the particular client. This view changed with the publication of Harry Markowitz's paper, Portfolio Selection, in the Journal of Finance in 1952. Markowitz's most valuable contribution was to shift that view to the risk of a whole portfolio of investments. Because individual investments can be less than perfectly correlated, adding a risky stock to a portfolio might not add to the risk of the whole portfolio, but could even reduce it. That is, it might diversify the risk of the portfolio and thereby mitigate the risk. Markowitz went on to win the Nobel Prize in Economics in 1990, which made for a great marketing hook for the financial industry. In his 1952 article, Markowitz stated this in a mathematical form. To do it, he needed to attribute 3 theoretical mathematical properties to securities. Each security's future expected return on investment. The variability of that future return, that is, how much it fluctuates over time, and the correlation between returns on 2 securities, that is, to what extent they move up and down together. Using these 3 properties, Markowitz constructed in theory what he called the efficient frontier of portfolios. To create it, he needed a number for each portfolio he could call its expected return, and a number he could call its risk. Technically speaking, the expected return and variability of a whole portfolio can be calculated from the properties he attributed to the individual securities in the portfolio. Hence, in Markowitz's simplification, each portfolio of securities has 2 characteristics: its expected return and its variability. Markowitz interpreted the variability of the portfolio's return, how much it fluctuates, to be the portfolio's risk. In theory, if you plot all portfolios' risks versus their expected returns, you get a graph that looks like figure 6. Markowitz concluded that the most efficient portfolios were those on the curved upper line, which he called the efficient frontier. Any portfolio on the efficient frontier had a higher expected return than any other portfolio with the same level of risk, and a lower risk than any other portfolio with the same expected return. Hence, no other portfolio is superior to it in both risk and return. Applying Markowitz's theory. Markowitz is a mathematician who was employed at the time at the Rand Corporation. Rand had been the innovator of important applied mathematics techniques in the field of operations research. Markowitz was now confronted with the mathematical challenge of finding out exactly which portfolios lay on the efficient frontier. The solution method he devised involved a mathematical technique called quadratic programming, not to be confused with computer programming. This methodology excited people in the field, especially in academia, as well as newly minted graduates of academic programs in finance. They set about trying to apply the Markowitz quadratic programming algorithm to create the efficient frontier of portfolios of public stocks. The first thing they realized was the sheer magnitude of the number of inputs that the method required. There were thousands of listed stocks. Markowitz's algorithm required an expected return and variability for each of them, and the correlation for each pair. If portfolios were to be constructed from 1,000 stocks, the algorithm would require 501,500 inputs. The second problem was that they needed to obtain numbers for the inputs. The obvious approach was to use historical data to estimate the inputs. So they tried using historical average returns for the expected returns, historical variabilities for the variabilities, and historical correlations for the correlations. When those numbers were fed into the model, the results that came out were absurd. A model that was supposed to reduce risk through diversification might instead say that the efficient frontier consisted of combinations of only 2 stocks. The reason was that those stocks were the ones that had the highest historical returns, and therefore they had been assigned the highest expected returns. Or they might be the ones with the lowest historical variabilities, and therefore they had been assigned the lowest future variabilities. No matter what they did, the modelers found that the outputs of the model made no sense. Eventually, they employed a combination of trial and error and mathematical reverse engineering to see what inputs would produce acceptable outputs. Reverse engineering means starting with a result and working backward to determine how it was produced, then using that knowledge to recreate the result. In the end, this is precisely how the Markowitz model is used. Its inputs are laboriously rigged to produce outputs that the modeler feels are acceptable. Oftentimes, analysts find it too difficult or too much trouble to rig the inputs to produce the desired outputs. In that case, they simply force the output variables, the portfolio weightings, to come out as they wish by imposing constraints on them. In other words, the desired outputs are specified, and then the inputs and constraints are created in such a way as to force the model to produce them. In the end, the Markowitz model may be a neat formula, but trying to apply it in the real world is hopeless because there's no way to get meaningful data to put into it. So in the end, you just have to fudge it. Portfolio optimization and asset allocation. Originally, programs that ran the Markowitz model to try to find the efficient frontier of stocks were called portfolio optimizers. They were supposed to find the optimum combination of stocks for a particular level of risk that would lie on the efficient frontier. As we've already seen, this proved extremely difficult. Because running the Markowitz optimizer on a large number of individual securities is so cumbersome, and constraining it to produce acceptable results is so difficult, it is now used only for asset allocation. That is, the number of assets in a portfolio is reduced to a small number, such as 10 broad asset classes. For example, the asset classes may include categories like small value stocks, small growth stocks, large value stocks, large growth stocks, perhaps mid-cap stocks, stocks of mid-sized companies, and short-term, intermediate, and long-term bonds. This exercise still requires rigging the inputs and usually constraining the outputs to be within acceptable ranges. Running an asset allocation on 10 asset classes still requires values for 65 input parameters. The end result has been the complete Orwellian perversion of the Markowitz model. Although financial professionals often boast that their firms use it, they don't really. Its implementers only go through the motions, using it chiefly as a sales tool. The model has proven useful only for its basic conceptual insights, not for its practical application. How asset allocation is actually used. Most financial firms that offer financial advisory services perform an asset allocation for their clients, or prospective clients, usually presented as a very important part of their service. They let people know that a sophisticated computer model is used to create the asset allocation. Frequently, they add that it employs Nobel Prize-winning technology. Through trial and error or other means, the investment firm has created, or outsourced the creation of, inputs to the model that produce an acceptable, efficient frontier of outputs. They then ask the prospective client for her current portfolio. From that, they construct her current asset allocation. Invariably, an asset allocation on the firm's efficient frontier will have a higher expected return for the same level of risk. That's because, quite simply, the firm has constructed the outputs of the model, the efficient frontier, so that they have higher expected returns at each level of risk than any other portfolio. So if you input any other portfolio, it will fall below the efficient frontier. Since there are an infinite number of other portfolios, they will all seem to be inefficient. The result, however, is due to the arbitrary inputs they have created, not reality. The efficient frontier could be any one of an almost infinite number of arbitrary efficient frontiers, and still serve the same purpose. The model is used as a marketing device, not to solve any real-world problem. The hoax that even good advisors perpetrate. In short, the idea that asset allocation needs to be done using a sophisticated mathematical model is essentially a hoax. A lot of the time, advisors don't even know it. They buy software from some vendor, and it does the asset allocation for them. The results of the asset allocation are determined by what the software provider put into the model. The results are whatever the software provider decided they should be. The model has little or nothing to do with it. But a lot of the advisors who use it believe it does. Even the good advisors muddy up what they get right with use of the asset allocation model that seems to have become, in spite of its actual uselessness, a sine qua non of investment advising. So let's first explain what the good advisors get right. Passive versus active investing. We're going to make a different use of the terms active investors and passive investors, than the meanings we assigned to them in Part 1. There, we called active investors investors who invest in their own business. That is, a business they run or participate in or are employed by. Passive investors, by contrast, were investors who only buy the stocks or bonds of a business that they otherwise have no involvement in. All of the investors we are talking about here are passive investors in that sense. But now we will mean something different by passive investors and active investors. Instead of picking and choosing stocks, passive equity investors just buy the whole stock market, or they buy all the stocks in some particular subcategory of the whole market. Some passive investment vehicles consist of bonds and buy a cross-section of the bond market. In contrast, active investors try to pick stocks or bonds that will beat the market. They do this in spite of the fact that, as we showed in Deadly Temptation number 1, study after study after study shows how futile this is. That's why more and more investors believe it's better to invest passively at low cost to try to match the market averages, not beat them. The best advisors know this and will tell you, because this is now so thoroughly proven, and has been for a long time, yet active investment managers still dominate the market by cunning marketing. There is a large and growing minority of investment advisors and managers who recommend and practice passive investing. Passive investing actually was originally derived from theoretical considerations, as the logical implication of Markowitz's theories. Markowitz's theories, as further developed by Nobel laureates James Tobin and William F. Sharpe, implied that the best thing you could do as a stock market investor is diversify to the maximum. Diversifying to the maximum meant buying the whole market. That's why we recommend just buying a world stock index fund. If you buy the whole stock market, all you have to do is hold on to it, because it will always be the whole stock market. You don't have to do any buying and selling, or hardly any, mainly only when a company pays a dividend that has to be reinvested, or when a new company goes public. If you own a world stock ETF, all that gets done for you by the ETF's manager, and for a very low fee. Feeding the fee machine. However, if you're an advisor and you simply recommend to your clients that to invest in stocks, they should just buy a single mutual fund, or ETF, a total stock market fund, they'll think you're not doing much for them. They'll think, well, what do I need you for? I could have done that myself. If you're an index fund investor whose advisor has done an asset allocation for you, he won't recommend just investing in one equity fund, a total market index fund. There's not much asset allocation to do if you only invest in one equity fund. He'll recommend that you invest in several asset groups that are sometimes called styles. For example, a large growth index fund, a large value index fund, a small growth index fund, and a small value index fund. And you run your asset allocation program among those, plus some bond categories. And what does your asset allocator spit out? Almost always, the asset allocator will combine all the stock fund styles in a mix that nearly replicates, guess what? A total market index fund. So instead of buying one total market index fund, you'll be buying 4 to 6 style index funds that together make up a total market index fund. What's wrong with this? Well, several things. First, the style index funds tend to charge more than a total market index fund. For one thing, they have to keep track of which stocks are in the style category. A large value fund is a fund that holds stocks in companies that are bigger than average and are trading for lower prices than you might expect, given their fixed assets. To know which stocks to put in it and to keep in it, you have to do some data screening and know when a stock moves in or out of the category. This is a more specialized field of investing, supposedly, than just running a total market index fund. So the fund manager probably charges at least a little extra. But there's more wrong, much more. Because stocks move in and out of the large value category, you have to buy and sell more often than a total market index fund buys and sells. And to whom do you sell and from whom do you buy? Why, you sell to or buy from someone who runs one of your other sector index funds. For example, if a large value company stock's market-to-book value ratio, a measure of its price compared to its fixed assets, goes too high to be in the large value category anymore, and thus becomes a large growth stock, then you can sell it to the manager of a large growth index fund. So your large value manager is going to be selling that stock to your large growth manager. There's no change in your portfolio, but you have to pay the two-way transaction cost. That's kind of pointless, isn't it? And it adds to the cost. So the asset allocation hoax not only doesn't benefit you, but also costs you something. But it costs you more than that because it's one of the main things that you supposedly need to pay your advisor for. And your advisor, even if your advisor is saving you a bundle by recommending that you invest in low-cost, passive index funds instead of high-cost, actively managed funds, is still charging you a bundle himself. A typical fee-only advisor charges 1% of assets. We saw in Deadly Temptation number 2 what 1% of assets in fees can do to your investments. And when you combine that with the little extra that is charged for style index funds, your investment gains may wind up being cut in half. Yet, all the conventional wisdom says how important asset allocation is. And it all comes from misinterpreting that 1986 Financial Analysts Journal article and misapplying Markowitz's portfolio optimization theory. Summary of Deadly Temptation number 3. 1. A 1986 article in the Financial Analysts Journal said that asset allocation explains 94% of the variation of returns, not 94% of portfolio returns. 2. Nobel Prize-winning optimization technology can be applied to asset allocation only by jury-rigging the inputs to create acceptable outputs. 3. The end result of the theories of Nobel laureates in finance is that the most efficient portfolio is one that mirrors the whole market, a total market index fund. Deadly Temptation number 4. Sleep well at night with your risk under control. Standard financial advice often includes a few misguided prescriptions that are intended to help control your investment risk. We'll now explore some of these and the reasons they're misguided. We told you that if you hear that you must diversify among many mutual funds or ETFs and asset categories, you should tune it out. Now we will tell you why you should tune it out. What modern portfolio theory actually says about diversification. The advice to be diversified comes from Nobel laureate Harry Markowitz's 1952 paper. Markowitz, as we learned in Deadly Temptation number 3, showed that if you diversify by buying a lot of stocks instead of only a few, then some of the stock's price fluctuations tend to cancel out, and you'll have a portfolio that fluctuates less without reducing its expected return. As we explained before, reducing your portfolio's fluctuations has been interpreted by the modern portfolio theory, MPT, folks, as meaning the same thing as reducing your risk. It's not really the same, though. Portfolio fluctuation risk is not the risk that matters. The real risk is running out of money when you need it. Markowitz's efficient frontier assumed you'd get more expected return if you took more risk. Nobel laureate William F. Sharpe went further by trying to quantify how much extra return you'd get by taking more risk. That is, more variability of returns. But he showed that you would only get more return for that risk if you were completely diversified. If some of that variability weren't diversified away, you wouldn't be rewarded for it with a higher expected return. As this theory developed, it wasn't too long before people, theoreticians initially, were starting to think about index funds, because they were as diversified as you could get. The common impression is that index funds were created because they are low in cost, but in fact, they were first created because theory implied that a total market index fund was the most efficient portfolio possible. This perspective can be extended not only to stocks, but to bonds too, and even to real estate and other assets. creating a total market portfolio of all marketable assets. There is no support in MPT for a procedure that some advisors now recommend, namely, slicing the equity market into styles, such as small value, mid-cap growth, and so forth, and allocating to a fund for each style. This approach can only detract, in theory, from the efficiency of a single total equity market index fund. Moreover, as we explained in Deadly Temptation number 3, it will add to the fees and transaction costs. It merely creates a perception of complexity and sophistication in a process that could be done much more simply. There's nothing wrong with diversification. It's generally a good idea. What's wrong is the way the concept can sometimes be distorted, confusing investors, complicating matters, and helping only to sell more high-priced products and services. Let's look at some examples. The mutual fund diversification myth. If you combine all stocks, you'll eliminate the volatile movements that are characteristic of each stock alone, sometimes called that stock's idiosyncratic volatility. You'll have left only the volatile movements of the whole market. So it's a good idea to hold a combination of all stocks. Does it follow that it's also a good idea to combine combinations of stocks? To combine mutual funds? No, not necessarily. It depends on what's in those mutual funds. If they all contain the same stocks, what's the use of combining them? You'll still have the same basket of stocks as if you'd only bought one fund. It wouldn't diversify you to combine several funds. So, would it help you to diversify if you bought 25 mutual funds? If you analyzed the stock holdings of most combinations of 25 equity mutual funds, they would tend to be very close to the whole equity market portfolio. Nevertheless, that's what a lot of financial advisors recommend. 25 mutual funds. They recommend it on the principle of diversification, as if diversification among equity mutual funds were the same thing as diversification among stocks. Very often, if you analyze the basket of stocks held by the combination of 25 mutual funds that a specific advisor recommends, which can be done using, for example, the mutual fund evaluation company Morningstar's Portfolio X-ray program, you'll find that what you've got is a total market index portfolio, but for much, much higher fees. Why does an advisor recommend such a travesty of an index portfolio, sometimes called a closet index portfolio? 2 reasons. One of them understandable, and one very bad. First, the advisor may not realize that holding mutual funds in several classes is very similar to holding an index fund. Yet, this has been the norm of the industry for years. In fact, for over 3 years, one of the authors of this book worked on asset allocation and manager index ETF selection for clients. And for a long while, he believed that he was doing the right thing for his clients. The second reason a financial advisor might recommend multiple active mutual funds is the higher fees associated with it. Some advisors, though not those known as fee-only advisors, get a share of the fees paid to the funds they recommend, a kickback. Mutual fund fees often have breakpoints at which the expense ratios go down. For example, some mutual funds charge one expense ratio for investments up to a breakpoint of perhaps $25,000 or $100,000, but a lower expense ratio for investments over the breakpoint. If an advisor recommends a large number of funds, the dollar amount in each fund may be below the breakpoint for lower fees, resulting in higher fees overall. This is one way, not a very pretty way to say the least, to jack up the fees. The myth of scientific style or asset class diversification. The style or asset class diversification myth would not be all that bad, except that sometimes it provides support for the mutual fund diversification myth, and it's also related to the myth of mathematically optimized asset allocation. The idea is that to be diversified in your equity portfolio, you have to diversify among several equity styles, or asset classes, with names like large growth, large value, small value, and mid-cap. These are all subclasses of the whole set of stocks. If you buy a fund that concentrates on each of these styles, together, your funds are fairly likely to approximate the whole stock market. In other words, they will add up to a closet index fund. However, the fees will be higher than if you bought only one total market index fund. Furthermore, as we explained earlier, the trading costs will be higher. The only reason to buy a style fund would be if you wanted to tilt toward that style. If you believed, for example, that small value stocks will do better than the market, so you wanted to overweight them. This is a form of active management, because it believes that a particular asset class will beat the market as a whole, usually because it beat the market in the past. But the Schwert rule suggests that there is no reason to believe such an anomaly will persist. If, however, that's what you believe, and you really want to follow that belief, and if you only want to tilt your portfolio in that direction, the best way to do that is to buy the total market index fund with most of your portfolio. Then buy a small value index fund with the rest. That will overweight you in small value stocks more efficiently than distributing all your purchases among many style funds. The hedge fund diversification myth. One of the ways hedge funds are sold is as diversification for an investor's portfolio. Hedge funds sometimes lay claim to diversification value through the very names of their funds. For example, absolute return is the name of a whole so-called asset class of hedge funds. Absolute return funds were meant to provide a return that wasn't correlated with the stock market. That is, a return that wouldn't go up when the market as a whole went up, and down when the market as a whole went down. They were supposed to provide an absolute return instead of a return that was relative to the fluctuations of the market. Their name implied the promise that they would go up in value whether the stock market went up or down. Funny, they didn't turn out that way. Absolute return funds were among the worst performing hedge funds when the market as a whole plummeted during the financial crisis. But they managed to get sold on their name anyway. Let's take another kind of hedge fund sold as diversification. One category of hedge funds is called long-short equity. This was the type of hedge fund pioneered by hedge fund manager Alfred Winslow Jones, whom we will encounter in Deadly Temptation number 6. In a long-short equity fund, the idea is to buy stocks you think will go up and short stocks, that is, sell them, that you think will go down. If you're right, a very, very, very big if, you make money whether the market as a whole goes up or down. Oddly, most long-short equity hedge funds don't do it in equal amounts. Typical is 70% long and 30% short. So they're, on balance, long the market. That is, they'll tend to fluctuate with the market. No matter, if they get the buys and sells right, the fund will do well, of course. But there's a big problem with the idea right out of the box. Mutual funds have shown quite clearly that professional investment managers don't get it right. Mutual funds can only buy stocks or sell stocks that they own. They're not allowed to short them. But as we showed in Deadly Temptation number 1, they've proven from their record that they don't get the buys and sells right any better than the proverbial chimpanzee throwing darts at the stock page of the Wall Street Journal. Even though mutual fund managers can't short stocks, if there's a stock they don't like, they could just not buy it and buy more of a stock they like instead. If they really knew which stocks were going to go down, they could easily beat the market that way. But they don't. Their record of failing to beat a market index shows that they don't know that. So, why would a long-short equity hedge fund know it if mutual funds don't? The hedge fund's argument is that before becoming hedge fund managers, these financial services pros were the best of the breed of mutual fund managers. They quit to start hedge funds because they have more investment freedom with unregulated hedge funds, and they'll be paid more. Therefore, they say, because they're the best managers, and they'll be freer to pursue their strategies, they'll do much better than the average mutual fund manager. But if they were previously mutual fund managers, and it's true that many hundreds, even thousands of them have quit to start or to work for hedge funds, And if they were so good, how come they couldn't raise the mutual fund performance average so it was at least better than the average of untrained individual investors? The argument simply doesn't add up. But it gets worse than that. Let's just stipulate for a moment that maybe a long-short equity hedge fund might possibly give you a better-than-market return, even after its ginormous fees. That, of course, wasn't the sales pitch, though. The sales pitch was that it offers diversification. If you're getting into this hedge fund to diversify your investments, that must mean that you have other investments, too, that you want to diversify, among them equity investments. In fact, those other equity investments probably own some of those same stocks that this long-short equity hedge fund sells short. You know, there's a better way to do this. If one of your mutual funds, or maybe even one of your hedge funds, bought a stock, and then you invested in another fund, a hedge fund that shorts the stock, you could achieve the same objective by just not buying the stock. The effect of the diversification the hedge fund was supposed to give you is that in your combined portfolio you don't have the stock because the buys and sells washed out. Yet, you're paying two different managers high fees, one to buy it and one to sell it. What kind of ridiculous diversification is this? But that's what actually happens. The totally missold target date funds. Another effort to provide risk control, specifically to individual investors, has been offered by so-called target date funds. At some point, target date funds became very popular in the United States for people investing in their 401ks, though they might have been making a mistake investing in their 401ks in the first place, as we'll point out in Deadly Temptation number 5. Target date funds became popular because they can be used as the default option in a 401k. If an employee who invests in a 401k has a choice of investment options but doesn't choose one, the fund administrator can, by default, place her investments in a target date fund. Target date fund managers loved this because they wound up with all the investors who didn't know what to do, which was most of them. And of course, they charged significant fees for their target date fund expertise. Target date funds are certainly not inherently harmful, but they suffer from the usual two problems. They don't really do much for you, and they provide an excuse for higher fees. So let's summarize these 2 points, which we'll explain later. Target date fund strategies are so simple that anyone familiar with the websites of their mutual fund providers could execute the strategy on their own in a time measurable in minutes per year. So there is little reason for target date funds to charge higher fees. Every target date strategy is equivalent to an even simpler constant mix strategy. That is, a constant mix strategy will produce the same probabilities of the same levels of wealth at a given future date, such as retirement. The target date fund principle. The idea of a target date fund is that you want to take less investment risk as you age. When you're young, you can invest in risky stuff, stocks basically, because there will be plenty of time for things to work out. The assumption is that stocks can be very volatile in the short run. So if you invest in them for a short time period, like a year or two, you could lose a lot. But you could gain a lot too. But in the long run, their fluctuations will even out, and you'll have a high probability of gaining. When you're older and getting ready to retire, or maybe you're already retired, you don't want to take much risk, and you don't have as long-term a time frame left to invest, so maybe stocks aren't such a good idea anymore. The idea of a target date fund is very simple. Invest a higher percentage in stocks when you're young than when you're old. One popular formula is that your asset allocation should be 100 minus your age. That is, your allocation to stocks should be 100% minus your age, and the rest should be in bonds. For example, if you're 30 years old, you should allocate 70% of your portfolio to stocks. If you're 40, you should allocate 60%. And if you're 60 years old, you should allocate only 40%. This is awfully easy to do. If you invest in stocks by investing in only one world stock index fund, as you really should, or perhaps only one total U.S. stock index fund, and one international stock index fund, and one bond fund, or one domestic and one international, you could do it yourself online in a few minutes a year. Well, that's if you've already figured out how to navigate the fund's website. As investing formulas go, this is certainly not terrible. It has the virtue of being simple. You could do it yourself easily. Marketers of target date funds came up with a name for this formula for winding down your asset allocation. They call it the glide path. This creates the impression of coming in for a safe landing. It gives people the feeling that their risk is under control. It's great for selling the funds. There are, however, lots of other simple formulas that would be just as good and are easy to execute yourself. In fact, purveyors of target date funds are all over the map on what strategy a target date fund should use. Some of them wind down your allocation to stocks to almost zero when you're 65. Others wind you down only to about 60%. The ones that did the latter got into big trouble in the financial crisis of 2007 through 2009. Investors who were invested in a target date fund that they thought would protect them in their retirement, and who were close to retirement, and who were all nice and ready to coast down the runway of life on their glide path, suddenly saw their target date fund lose 20% or 30% or even 40% of its value. So, after the financial crisis, a lot was written about the failure of target date funds. But the failure was not of the funds. It was the failure of the marketers of the funds to make clear to investors and to financial journalists just what the fund's risks were and what the fund's objectives were. Instead, they left investors and journalists with the impression that target date funds protect you against risk when you're almost retired. The glide path meme helped them do that. After the crisis, after the fact, they backtracked to explain that significant risk-taking is a good policy, even when you're at retirement age. One Wall Street Journal article on target date funds' problems during the financial crisis said, "Of course, the selling point of target date funds is their simplicity. Put your money into one fund based on when you expect to leave the workforce, and the experts will take care of the rest." Experts? What expertise? Target date funds do the simplest thing in the world. Any idiot could do it, in a few minutes a year, as we said. But most people don't want to be bothered. But to be led to believe they're letting the experts take care of it? It's hogwash. The trouble, of course, with believing that kind of bunk is that you allow people who present themselves as experts to charge you a huge bundle of money for what is, at worst, snake oil, and at best, a trivial clerical task that you could easily do yourself. Target date versus constant mix strategies. No evidence exists that a target date strategy will ensure you of any specific level of retirement income. Certainly not as well as tips and annuities do. In fact, the so-called target date strategy of reducing your allocation to stocks over time, in accordance with a formula, can be shown to give exactly the same likelihood of the same results as keeping your allocation constant. Suppose, for example, that you're using the 100 minus your age formula, and suppose you contribute 10% of your salary a year to your fund from age 25 to age 64. At age 25, your allocation will be 75% stocks, 25% bonds. At age 26, it will be 74% stocks, 26% bonds, and so forth, until at age 64, it will be 36% stocks, 64% bonds. How will your results in retirement with the target date fund compare with the results you would get if you just used a constant mix? The answer? The results will be exactly the same. There is a constant mix, in this case 49% stocks, 51% bonds, that gives you exactly the same chances of various levels of wealth accumulation at age 64 as the changing mix of the target date fund. For example, using reasonable assumptions, Table 3 shows the probabilities of various levels of wealth accumulation at age 65 with the target date strategy, and with an equivalent constant mix strategy. The table shows that with both strategies, there is a 50-50 chance of accumulating at least $887,000, a 10% chance of accumulating less than about $640,000, a 1% chance of accumulating less than about $500,000, a 10% chance of accumulating more than $1,250,000, and less than a 0.1% chance of falling below $400,000. In short, there's hardly any difference between the two. So how exactly does the target date fund control your long-term risk compared to the constant mix strategy? The answer is, it doesn't. Target date funds neither improve nor guarantee people's retirement lifestyles, any more than a number of other arbitrary strategies. Of course, sellers of these funds don't make any of that clear. And in truth, much of this may not be known to them. All they have to do is leave the impression that the experts will take care of the rest, as the Wall Street Journal reporter wrote. And people believe it, especially when a financial journalist, one who is not sufficiently skeptical of what he is told and doesn't have time to investigate deeply, says it too. And in the Wall Street Journal, no less. The problem is that if you buy into the idea that you need an expert to do something for you that is so simple, and if you pay that expert 1% a year to do it, suddenly something that is just a harmless rule of thumb becomes toxic to your finances, depleting your assets by an amount, as we showed in Deadly Temptation number 2, that could range from 1/3 to 3/4 of your investment gains. Summary of Deadly Temptation number 4. 1. Diversification among many mutual funds or fund sectors is often only closet indexing. It is a more inefficient and costly way to diversify across stocks than a total market index fund. 2. Hedge fund diversification is in most cases a myth. Hedge funds charge extremely high fees and will often merely duplicate or cancel out other holdings in the investor's portfolio. 3. Target date funds follow a very simple rule of thumb that does not necessarily benefit an investor, but may be comforting. It is harmful, however, if it entails higher fees. Target date investing also offers no greater risk reduction compared with a constant mix strategy. Deadly Temptation number 5. Use the strategies that always work. There are some things about investing you hear so incessantly that by now everybody just assumes they're right. The conventional wisdom is so riddled with error that you should question virtually everything you hear. In this Deadly Temptation, we'll address the following 4 things you hear that are either wrong or at least not always right. The first thing you should always do is fund your 401k to the max. You must be sure to rebalance your investments regularly. Dollar cost averaging always wins. Gold is a hedge against inflation. Funding your 401k to the max. Or not? What? Are we going to say it's wrong to fund your 401k to the max? You may find this hard to believe, but yes, that's what we're going to say. Now, it's not always wrong, but it's often the wrong thing to do, and it may be wrong more than half the time, so you need to think about it. You shouldn't do it automatically. To decide whether you should fund your 401k to the max, you need some information. Unfortunately, it may be extremely difficult to get the information you need. You may have to do a lot of demanding to get it, and even then you might not. Back to basics. Transferring the risk from the employer to the employee. We need to provide a few basics about 401k plans. This discussion applies only to U.S. residents and employees. Other countries have similar plans, but everything could be different. A 401k is provided as a retirement benefit to U.S. employees by their employer. Until the 401k plan was invented in 1980, most employee benefit funds were defined benefit pension plans. That meant the payments employees would get when they retired were determined once and for all, usually as a percentage of their average salary in their last few years of employment. In a pension plan, it was up to the employer to make sure the employees got those payments. Employers had to both put money into the pension fund and hope to get a good return on its investments. If the fund didn't earn a good enough return on investment, the employer had to put more of its own money into the fund to make up for that. The 401k plan, instead of being a defined benefit plan, is a defined contribution plan. Instead of the amount of the future retirement benefit being defined once and for all, the contribution to the fund that both employee and employer make is defined. How much you, the employee, earn later is uncertain. It depends on the return on investment your 401k plan earns. This arrangement transferred the investment risk from employer to employee. Employees now bore the risk of not getting as much later as they hoped if the fund's returns didn't turn out well. Not only did the employer slough off the risk of committing to specific amounts of retirement benefits, but the employer had to contribute less to the fund. The contribution became the employee's responsibility. Most employers made up partially for the loss of their burden by matching employees' contributions to their 401k plans up to a certain amount. Now, you'd think employees would be unhappy with suddenly getting stuck with all the investment risk. But remember when the 401k was invented. It was right at the dawn of one of the longest bull markets ever. In the 1980s and 1990s, investment returns were spectacular. Employees actually thought they were getting a bad deal with pension funds because they defined way ahead of time what they were going to get in retirement. They didn't allow the employees to cash in on the great investment returns they heard about constantly. They wanted a piece of those. The 401k, where they could invest their own money and reap the high returns, seemed to give it to them. Well, yes, until it didn't, of course. Rules of the game. Let's begin by summarizing the surprising result. A lot of the time, for perhaps about half of all 401k plans, you should not contribute as much as you can to your 401k plan. Let us explain. Both employer and employee can contribute to the 401k plan. The U.S. government allows the employee to deduct the amount of her contribution from her taxable earnings, up to a maximum contribution which was $17,500 in 2013 and 2014, or $23,000